Good morning, everyone, and thank you for joining us. My name is Sherry Bubowski, and I have an echo here that I'm going to fix. If you give me 1 second, I do apologize for that. Good morning, everyone. Thank you for joining us. My name is Sherry Bubowski. I am the Retirement Benefits Manager at the Fund Office. I have been with the Fund Office for 34 years, and I've probably done, between in-person seminars and webinars, I've probably done close to 100 of these. So I would like you to know that I appreciate your spending some of your Saturday with us in order to learn a little bit about your pension benefits. If you are having trouble hearing, you can watch the webinar on your computer or your phone or your tablet, and you can call in and listen to the broadcast over the telephone. So the phone number is here and the access code is here so that you can do that if you would like to. The supporting materials for the webinar, there's several handouts, a handout about pension, a handout about health benefits, beneficiary forms, and benefits from the Midwest Coalition of Labor organization. So those handouts were actually emailed to you this week, but if you don't have or can't access that email, they are available if you're watching this on a computer. You can click the orange arrow on the sidebar and that will open up a window to the handouts. If you're watching it on a phone or a tablet, toward the bottom of your screen, there should be a little gray button that says handouts, and you could just click on that. I will pause for questions at the end of each section. To submit a question, you would click on the questions button, again, to the right of your screen if you're on a computer, desktop or laptop, or on the bottom of your screen if you're on your phone or a tablet. Now, there are 161 of you registered today, and there's one of me. I am not going to be able to get to all of your questions. The questions that you do ask today through the chat box, I would ask that you keep those general questions, things that everyone might be interested in. If you have specific individual questions about your own pension credit or your own record or your own estimates or anything else about your own personal situation, I strongly encourage you to call the Retirement Benefits Department at the Fund Office to address those questions. Anybody on the Retirement Benefits team would be happy to assist you with those personal questions that apply to your record, or even perhaps a general question that I don't get to today during this presentation. This recording today is being this webinar today is being recorded, and it will be posted on our website. In fact, the webinar from last April is currently posted on our website. So at carpenterbenefits.org, if you click on resources, the top option under that is called Video Library. And right now you can see the recordings from the April webinar. It'll take about a week for our IT department to get today's webinar up and loaded onto the website. But if you missed something, or you can't remember what I said, or you want to go back and review a certain section, or maybe you even need to leave early today, those recordings will be available for you. Okay. This is the first time that we have done a webinar and had our participants access their individual information through our new participant portal. We're very, very excited about this participant portal. It took years to develop. The QR code on your screen, if you scan that, it will take you right to the portal if you need anything else, or if you have not yet pulled down your pension credit record or your individual estimates. If you don't scan QR codes, you can also go to our website at carpenterbenefits.org and click on Member Login in the top right-hand corner, and that will take you to the portal where you can see your individual pension credits and your individual estimates, which we'll be looking at during today's broadcast. You can also see things on there like your employer contributions, how many hours your employers have been paying in on your behalf, You can see your active health benefit eligibility, and you can see your active plan medical claims and any weekly disability claims. So all of that is now available through the participant portal. When you exit the webinar today, there's a short survey. I think it's 5 questions long. So if you would take a moment to complete that, if you don't have time today, the survey, it will also be included in a follow-up email that you will receive either tomorrow or Monday. So surveys and answers to surveys have generated a lot of changes in this broadcast and in the seminars over the years. We do take your questions and your feedback seriously, and I would appreciate, maybe 2 minutes of your time to fill out that seminar. Also, if your situation changes, we want to know if you move or you get married or divorced, or maybe you have another child, please contact the fund office so that we can update your information. You should also consider updating your beneficiary if there are any changes, such as getting married or divorced or your spouse passes away. Actually, I would also mention that if indeed you move, you always in the past had to call the fund office to update your information. Now, giving the portal just one more plug before we move on, you can actually update your address, your email, and your telephone number through the participant portal. And then here's the legal disclaimer. If there's anything on my slides today that is contrary to the information contained in the plan documents will govern the situation. So the slide here is just an overview of our topics today. We are briefly going to talk about how you've earned your pension credit over the years. We will spend the bulk of our time talking about your pension calculations and the different payment options. We'll talk a little bit about disability pensions. We'll spend some time on pre- and post-retirement death benefits. We'll talk about requirements to start your pension as far as filing an application and what type of work that you need to stop doing to start your pension. We'll talk about prohibited employment after your pension begins. And we will also talk about the supplemental retirement plan. After we get through those pension topics, then we will spend the latter part of the presentation talking about retiree health benefits, the premiums, the coverages, whether or not you can postpone coverage, all of those types of things will be covered in the retiree health benefit section. So our first topic is how your pension plan benefits are determined. So let's talk about earning pension and vesting credit, pension calculations, and your pension payment options. Okay. Through the portal, we asked you to access your own personal pension credit record so that you could see that and have that available to you today. On the portal, the default is that you can see 10 years of credit at a time. Toward the top left of the portal screen where your pension credit is displayed, there's a drop-down box. You can change that 10 lines down to 100 lines so that you can see all of your credit at once. You can see the credit that you earned on a year-to-year basis from either the construction pension plan or the Millman pension plan. If you've earned credit in both plans, then you will be able to see credit from both plans on the participant portal. Also, your totals are listed on the participant portal. So you have earned these pension credits over the years by the number of hours that you've worked for a contributing employer who has a collective bargaining agreement with the council and the plans. On a calendar year basis, January 1st through December 31st, your hours are accumulated and result in pension credit. Under the construction pension plan, less than 250 hours in a calendar year does not give you any pension credit. At least 250 hours gives you a quarter, 500 a half, 750 gives you 3/4, and 1,000 gives you a full year. For the construction pension plan starting in 1989, it became possible to earn these kind of bonus credits. So for 1,500 or more hours, you pick up a year and a quarter of pension credit. And for 1,750 or more hours, you would pick up a year and a half of pension credit. On the Millman pension plan, the hours requirements are the same for the quarter, the half, the 3/4, and the 1 year. You cannot earn the year and the quarter or the year and a half in the Millman pension plan as of right now. So you're limited to a maximum of 1 year of credit per calendar year in the Millman plan. So your totals on the portal show something called vesting credit versus something called pension credit. Vesting credit is what we use to determine whether or not you are eligible for a pension benefit. Currently, in order to be eligible for a pension benefit, you need 5 years of vesting credit. That requirement has changed over time. In fact, it's decreased over time. Prior to 1976, you needed at least 15 years. Starting in 1976, the requirement went down to 10 years, and as of 1999, that's when the 5-year requirement went into place. In the construction plan, although it is possible to earn a year and a quarter or a year and a half of pension credit within any given calendar year, for vesting, you can earn a maximum of 1 year per calendar year. So your vesting credit is looked at to determine whether or not you are eligible for a pension benefit. And it is also translated into something called eligibility credit for the healthcare benefits. Now, again, we'll talk about healthcare benefits a little later in the presentation, but I did want to mention this since we are currently looking at your pension credits. Pension credits turn into what's called eligibility credit for health benefits, provided that the employer that you were working for was signatory to and contributed to both the pension fund and the health and welfare fund. Okay. So the eligibility credit is also limited to a maximum of 1 year per calendar year. Now, the pension credit, where those extra quarters and halves come into play on the pension for the construction plan, is during your pension benefit calculation. So we also asked you to access your own personal estimates for today's presentation through the participant portal. You were able to decide if you wanted to look at information for either a disability pension or for an early pension or a perhaps normal pension if you are already age 60 or 65. So you could select what type of pension you wanted, and you could select the pension date that you wanted to look at when you generated your own estimates through the portal. Okay. Something I do want to mention is that your estimates, either when we at the Pension Fund Office run them or when you run them yourself through the portal, the estimates that are generated are based on any pension credit that you have earned up to the present date and time. So if you have entered on the portal that you're interested in beginning your pension, say in March of 2024, the credits that are used to generate that estimate are still based on the credit you've earned up to now, because we cannot predict how many years of pension credit you will earn in future years. So these individual estimates show you 3 different payment options. The first one's called a single life annuity with a 60-month guarantee. And then there are 3 options if you are married, called joint and survivor options, a 50%, a 75%, and a 100% joint and survivor option. And we will talk about all of those different options. We'll go through all of the options, what they all mean, and what all the provisions are with respect to those individual options. Also on your estimate that you generated, your estimate reflects your participant age, okay? Age is counted as of the first of the month. So even if your birthday isn't until maybe August 15th, if you selected August as a pension start date, we would count you the age that you will be on August 15th, and maybe it's going to be your 60th birthday on August 15th. We would consider you to be 60 as of August 1st. So you can start your pension in the first of the month that you will reach a certain age. Some people think that you need to wait until the month after your birthday in order to begin your pension and to be considered age 55 or 60 or 62. But it is actually at the beginning of the month in which your birthday happens. So your pension benefit calculation is determined by the number of years of pension credit that you have earned, including those additional quarters or halves on the construction pension fund, the accrual rate in effect at the time you earned credit or commenced your benefit. We look at whether or not you, at some point in your career as a carpenter, experienced what's called a 3-year calculation break. Now, that means that you went 3 consecutive calendar years without earning at least 1/4 year of credit in the pension plan. Okay. We also look at the type of pension benefit that you will be eligible for when you retire. Now, the current benefit accrual rates for both the construction and Millman pension plans, as of July 1st, so as of this month, the construction plan accrual rate is $125. That was a big benefit improvement that the trustees are very proud of, and they were able to put through for pensions effective this month and going forward, provided that you never experienced a 3-year calculation break during your career as a carpenter. The current Millman plan accrual rate is $66 per year of pension credit. Again, provided you never experienced a 3-year calculation break during your career as a carpenter. I have some examples of calculations that happen if indeed at some point in time you did experience a 3-year calculation break. Any credit earned prior to that 3-year period that you went without earning credit will be locked in at the accrual rate in place when you last earned those credits before that calculation break. I have several examples in our slides, so if my words are maybe a little bit confusing, we'll look at those things in examples so that we can go through them in more detail. Okay. The pension plans provide for the following types of benefits, and each benefit has a different eligibility requirement. So both the construction plan and the Millman plan provide for a regular pension if you are vested and you are at least age 65. The construction plan provides for what's called an unreduced early pension if you are vested and at least age 60. Both plans provide for an early retirement benefit. On the construction plan for an early retirement benefit, you need to be at least age 55. And on the Millman plan, to be eligible for an early pension, you need to be at least age 60. Okay. If you are commencing your pension benefit prior to age 60 in the construction plan, you will incur what's called an early reduction factor, an early reduction, and that reduction is 5% a year for each year that you are younger than age 60. So for example, if you are going to commence pension benefits at age 59 from the construction plan, you are 1 year younger than age 60, so you would have a 5% reduction. Okay. Now that 5% is prorated by month. So if you are going to start your pension benefit, say at age 59 and 11 months, you don't incur a whole 5% reduction because you're only 1 month younger than 60 if you're starting at 55 and 11 months. So we would take the 5% and divide by 12. So your reduction is 1/12 of 5% for each month younger than age 60. The Millman Plan is a little bit different. In the Millman Plan, you cannot commence an early until you're at least age 60, and age 65 is the age at which there is no reduction. In the Millman Plan, if you are commencing benefits prior to age 65, so for example, say you're going to commence benefits at age 64, you would incur a reduction of 6.6% because you're not yet 65, and that 6.6% is per year. Again, it is prorated monthly, so divide by 12 for your monthly reduction if you are going to commence benefits prior to age 65 in the Millman Plan. Okay. Both plans provide for a disability pension, and we'll look at specific requirements in order to be eligible for a disability pension later in the webinar. If you commence benefits on a disability pension, there is no early reduction factor applied to the benefit calculation, no matter how old or young you are. Okay. There's also a final category of pension types called partial and limited pensions. A partial pension could apply if you worked some of your years here in Chicago, and maybe you also worked a few years out in California, or maybe a couple of years out in New York, or maybe a year or two down in Florida. So a partial pension lets our fund kind of do a coordination of benefits with other funds across the country. A limited pension applies if you have earned credit both in the construction and in the Millman Plan here out of the Chicago office. So it's a way we can coordinate benefits between the construction and the Millman plans. So those were the different pension types. Now getting back to your individual estimates, a base pension, the base pension that we start with for all of our calculations, is called a single life annuity with a 60-month guarantee. And on your estimates that you've looked at or perhaps even printed or downloaded from the portal, the base single life annuity 60-month guarantee, that's on the middle of the page of your estimate. Okay. Now, what does that mean? What is a single life annuity with a 60 certain guarantee? Well, that dollar amount quoted on your personal estimate there is a monthly benefit payable for your lifetime, the carpenter's lifetime. There is no maximum number of payments. So if you live for another 40, 50, 60 years, you will still receive monthly pension benefits every single month for the rest of your lifetime. There is no maximum number of payments. In fact, the pensioner currently receiving benefits, who's been on pension for the longest, he is 97 years old, and he has been receiving pension benefits for 42 years. Okay, so there is no maximum number of payments on that single life annuity. However, there is something built into this called a 60-month guarantee. So if you choose this single life annuity with 60-month guarantee, and if you, the carpenter, pass away before you have received 60 monthly payments, and by the way, 60 months is equivalent to 5 years. So if you pass away before you receive 60 monthly payments, the fund office will pay the remainder of those 60 payments to your designated beneficiary. And we'll look at that on the next slide also. So let's look at an actual calculation example for this single life annuity 60-month guarantee benefit. So in this example that we're going to take through most of our slides today, the carpenter is 60 years old. He worked for 41 calendar years in the construction pension plan from 1981 to 2021. He earned 49 and a half years of pension credit, even though he only worked 41 years. He earned 49 and a half years of pension credit due to those extra halves and quarters. And in this example, the carpenter never went 3 consecutive calendar years without earning at least a quarter year of pension credit. So the calculation is very straightforward. We take the 49 and a half years of pension credit and we multiply by the current benefit accrual rate of $125, which is now in place as of July. Because this retiree out of the construction pension fund is at least 60, or he is 60, there is no age reduction in this calculation. So it's just a straight multiplication. 49 and a half years times $125 yields a monthly pension benefit amount, a base pension amount of $6,187.50. So the carpenter would receive that $6,187 a month for the carpenter's lifetime as long as the carpenter lives. Okay. However, going back to the 60 certain, if the retiree passes away after only receiving 48 monthly payments, the fund office has not fulfilled its guarantee of 60 months, so the final 12 payments that the retiree would have continued to receive had the retiree not passed away, those last 12 payments will be paid out to the retiree's designated beneficiary. So 48 payments to the carpenter before the carpenter passed away, and then 12 more payments to the beneficiary, adding those two together. That gives you the 60 monthly payments. Now again, please remember that if the carpenter is still living, the monthly benefit continues past the 60 months. So sometimes people think, oh, that only gives me 60 monthly payments and then the pension stops. That is not true. The monthly pension continues for the carpenter's lifetime, however long the carpenter lives. It's just that if the carpenter passes away after the carpenter has already received 60 or more monthly payments, no additional monthly payments would be due to the designated beneficiary upon the carpenter's passing under the 60-month guarantee, the single life annuity with the 60-month guarantee. Now, for those of you who are married, there are options, and you can actually see those on your estimate, called joint and survivor options, that allow you to provide a monthly benefit for a surviving spouse in case the carpenter passes away first. And we will look at those in some upcoming slides. Okay, so right now we're just looking at the 60 certain guarantee. So our next example is of a carpenter from the construction pension fund who is not yet 60 years old and is going to commence benefits under an early retirement pension. So in this example, the carpenter is 58 years and 2 months old, worked for 32 calendar years, and due to those extra halves and quarters under the construction plan, earned 42 years of pension credit and never incurred a 3-year break in service during the career as a carpenter. Okay. So the math is just like our prior slide. We take these 42 years of pension credit, we multiply by the current accrual rate of $125. But because this carpenter is not yet 60, there is an early reduction factor involved. So 5% a year for each year younger than 60. If the carpenter was a straight up 58 years old and no months, 58 years and 0 months, this factor would be 90%, 5% a year for each year younger than age 60. However, since in this example, the carpenter is 2 months older than that, he gets a little bit extra tagged on here. So this is 2/12 of 5% that's tagged on here for the reduction factor for 58 years and 2 months. So the 42 years multiplied by $125 multiplied by 90.833%, would give this carpenter a monthly amount of $4,768. Okay. Again, payable for the carpenter's lifetime as long as the carpenter lives. If indeed the carpenter passes away before getting 60 monthly payments, the remaining payments would be paid to the carpenter's designated beneficiary. Our next example, click twice. Our next example is of someone who has incurred a 3-year break in service. So a 3-year break in service, again, at some point in time, you went 3 consecutive calendar years without earning any pension credit at all, not even a quarter of a year. So in this example, the carpenter is 58 years old, worked from 1988 to 1996 and earned 11 3/4 years, did not earn any pension credit at all for the 3-year period of 1997, 1998, or 1999. So that's the 3-year break in service. But then the carpenter returned to service and worked again from 2002 to 2021 and earned an additional 21 3/4 years of pension credit. So it's a 2-step calculation. These 11 3/4 years of pension credit that were earned from 1988 to 1996 are multiplied by the 1996 accrual rate of $50. And then because the carpenter is only 58 years old, he incurs a 10% reduction. So that monthly benefit of $528.75 is added to the second calculation. So the second calculation is the 21 3/4 years earned from 2002 to 2021, which is after the 3-year break in service. Those years are multiplied by the current accrual rate of $125. And again, there's still the early reduction because the carpenter is only 58 years old. So that gives us a total of $24.46. We add those two amounts together to arrive at the monthly benefit amount of $29.75, which would be payable for the carpenter's lifetime. Now, in this example, the carpenter has 2 lines of calculation because he returned to covered employment after that 3-year break in service. A couple of you registered here today. You stopped earning credit back in the 90s or maybe in the earlier 2000s, and you did not return to covered employment and earn additional credit. And that's just fine. But you'll notice on your individual estimate, there's only a 1-line calculation, and your accrual rate for that 1-line calculation is the accrual rate in place when you last earned credit. The chart of the accrual rates can be found on our website in the summary plan description if you're interested in that accrual rate chart. It has gone up considerably over time. So you can check out that chart if you would like to. But you can also see the accrual rate applicable to your individual record by generating estimates through the participant portal. So for those of you who are married, there is also something called a joint and survivor option. So the joint and survivor options offer a way for a surviving spouse to receive a lifetime benefit in case the carpenter passes away first. So following the death of the carpenter, the spouse starts to get a monthly pension benefit, and that monthly pension benefit would be payable to the surviving spouse even if the surviving spouse subsequently remarries. Okay? So it is a lifetime benefit for the surviving spouse. Both the construction and the Millman Plan offer 3 options, a 50%, a 75%, and a 100%. If indeed you are married, federal regulations require that you take at least a 50% joint and survivor benefit unless your spouse is willing to sign a consent form to allow you to take the full pension, that single life annuity with the 60 certain, in order for a married participant to take that 60 certain single life annuity, your spouse at the time your pension starts needs to sign a consent form. So let's look at some calculations with the joint and survivor pension. And you can see your own individual calculations on the estimates that you either downloaded or printed from the participant portal. So we're going to go back to our original example where the retiree is 60 years old and earned 49.5 years of pension credit. The retiree is 60 and the spouse is also 60 years old. So the base calculation we've already looked at, 49.5 years times $125 gives a monthly pension of $61.8750 for that single life annuity 60-month guarantee benefit. So the joint and survivor benefits are calculated by starting with this monthly benefit amount of $61.8750. On the 50% joint and survivor benefit, we take that $61.8750, and because the carpenter and the spouse are the same age, the joint and survivor factor here is 90%. Now, you can see your individual joint and survivor options that apply to you and your spouse on the estimates that you pulled down from the portal. On a 50% joint and survivor, 90% is the base when the carpenter and the spouse are the same age. For each year younger or older than the carpenter that the spouse happens to be, we add or subtract 0.4% to that 90% base. So if your spouse is 1 year younger than you, we're going to take the 90% and subtract off 0.4% to arrive at the new joint and survivor factor. If your spouse is 1 year older than you, the carpenter, we're going to take the 90% and add back on an additional 0.4%. Now, the actual 0.4 or the tenths that I'll talk about in the next three examples, it's not terribly important for you to remember that because you can see that on your individual estimates. Okay. So we take the $61.8750, we multiply by the 90% factor, and we get the amount that the carpenter will receive during the carpenter's lifetime. So under a 50% joint and survivor, instead of receiving the $61.87 a month, the carpenter will receive $55.68 a month. That benefit is for the carpenter's lifetime. And upon the passing of the carpenter, the $55.68.75 goes away, but the surviving spouse starts to receive $27.84 for the surviving spouse's lifetime, and that is half of the carpenter's amount. So the carpenter draws $55.68 for the carpenter's lifetime. When the carpenter passes away, the $55.68 stops, but the surviving spouse starts to get $27.84 for the surviving spouse's lifetime. The 75 and the 100% work the same way. On a 75% joint and survivor benefit, if the carpenter and the spouse are the same age, we start with an 85.5% factor, and then we add or subtract 0.6% to that factor for the difference between the spouse's age and the carpenter's age. So on a 75% joint and survivor, the carpenter would draw $52.91 a month for the carpenter's lifetime. Upon the carpenter's passing, the $52.90, I'm sorry, I said $52.91 before, and of course I meant $52.90.31. Upon the carpenter's passing, the $52.90.31 stops, but the surviving spouse starts to receive 75% of that amount, or $39.67.73, and the surviving spouse will receive that amount for the surviving spouse's lifetime. On a 100% joint and survivor benefit, we still start with the $61.87 from the 60 certain guarantee amount, and we multiply by the joint and survivor factor of 81%. That's if the carpenter and the spouse are the same age. For each year difference, we add or subtract 0.7%. Okay. So that gives us a monthly benefit under the 100% joint and survivor option for the carpenter of $5,011.88. If the carpenter passes away, the carpenter's $5,011.88 stops, but the surviving spouse begins to draw a monthly pension benefit in that same amount, in 100% of the carpenter's amount. So when you complete your pension papers, you will make a choice as to which of these options you wish to choose. Do you want the single life annuity with the 60 certain of $61.87 in this example? Or do you want a 50% where the carpenter draws $55.68? Or do you want the 75% where the carpenter draws $52.90? Or do you want the 100% where the carpenter draws the $5,011? So you make a choice between the 4 options that are listed on your estimate. And of course, you can see the surviving spouse's monthly benefit listed on your estimate in case the carpenter passes away first. Now, what happens if the joint and survivor options are chosen? One of the joint and survivor options is chosen. What happens if the surviving spouse passes away first? And of course, it would be not a surviving spouse. What happens if the spouse passes away before the carpenter? So all of the joint and survivor options have a pop-up feature built into the joint and survivor options. And this applies to both the construction pension plan and the Millman pension plan. So the benefit would automatically convert the joint and survivor amount back to the base 60 certain amount upon the spouse's passing. And it doesn't matter how long the carpenter has already been on pension. Okay. This adjustment starts the month after the spouse dies, so you don't get any retroactive money kind of given back to you, but the pop-up starts the month after the spouse passes away. So for example, in our example that we've been working with, let's say the carpenter chose the 50%, so the carpenter was receiving $55.68.75 for the carpenter's lifetime. And the anticipation was if the carpenter passed away first, the surviving spouse would start to draw $27.84 for the spouse's lifetime. Well, since the spouse has passed away first, it's no longer necessary to hold on to this 50% joint and survivor option. What will happen is the carpenter's monthly benefit will be popped back up to the full single life annuity 60-month guarantee amount effective the month after the spouse's passing. Now, I say automatically. It isn't a plan feature that's automatic, but of course, the fund office has no way of knowing if your spouse has passed away unless you call and notify us. So you do need to notify the fund office that your spouse has passed away, and you also need to send us a copy of your spouse's death certificate so that we can make this adjustment to your monthly benefit amount. Okay. And this applies again to both the construction pension plan and the Millman pension plan. For the construction pension plan, there is also a 60-month guarantee built into the joint and survivor options. Now, this only applies to the construction pension plan. This built-in 60-month guarantee is not part of the Millman plan provisions. So on the construction pension plan, let's say the retiree passes away after only receiving 20 monthly payments and a joint and survivor option, one of the 3, it doesn't matter which one, the 50, the 75, or the 100%, but one of the joint and survivor options was chosen by the retiree. Retiree gets 20 monthly payments and passes away. The surviving spouse's pension begins at month 21 in the surviving spouse's amount. Let's say the spouse receives an additional 12 monthly payments. So together, the carpenter and the spouse have received 32 monthly payments. But let's say the surviving spouse passes away after only getting those 12 payments. So we've only paid 32 payments in conjunction between the carpenter and the spouse. So the retiree's designated contingent or secondary beneficiary will receive the remaining 28 monthly payments to bring us up to a total of 60. 28 plus 12 plus 20 brings us up to the guaranteed monthly benefit of 60 certain. When you fill out your pension papers, and in the handouts today, there was a sample pension application packet. On question 6.2 of the pension application, you're going to be asked to indicate on that pension application which of the options are you and your spouse choosing. So if you're not married at the time of your pension commencement, you'll need to check the A line to say that you've chosen the single life annuity with a 60-month guarantee, because you really don't have another choice if you're not married on your pension commencement date. But if indeed you are married, you could pick a 50%, a 75, 100, or the single life annuity. So you'll check the appropriate box, you sign the form. If indeed you are married on your pension commencement date, your pension application time, your signature, your spouse's signature is required on this page, acknowledging that your spouse knows which option you've chosen. Now, please note that once your benefit is in pay status, this election cannot be changed unless your spouse passes away first. Then we change you up to the 60 certain guarantee automatically. Okay. There's a question about the partial lump sum amount coming through on the chat, and I will definitely be talking about the partial lump sum in the next few slides. So if you give me a moment, we will get to that. Also, although I'm going to pause for questions at the end of this particular section, while I'm talking, if you think about a question, go ahead and pop it into the chat so that I can keep a lookout on those and speak to those when we get to the end of the section. Okay. So far we've talked about the first estimate that came up on the portal when you pulled up your estimates. And that's the estimate that just shows what a straightforward monthly benefit would be for either you, the carpenter, or perhaps for you and your spouse on the joint and survivor options. You have an option, and this applies to both the construction plan and the Millman plan, of taking up to 10% of the total value of your pension as an actuarial equivalent lump sum. So if you choose to, you can take up to a maximum of 10% of your pension in a chunk of money up front. Okay. So this is what the lump sum estimate looks like. I have some slide examples where we're going to look at the actual calculation. But on the estimate, this page looks a little bit different from the first page you downloaded or printed, because you'll see a lump sum amount up here on the top, and then you'll see the 60-month guarantee and the joint and survivor options as you move down your personal estimate. So let's take a look at some information and some calculations. You can opt for a maximum of 10% as a lump up front. However, the minimum amount that you can choose as a lump sum is $1,000. And the actuarial factor that's used to calculate the lump sum amount changes every July. It's based on your age at the time of your pension effective date, and there is no way for the pension fund staff to predict whether or not these actuarial factors will go up or go down when they change in July. They are based on a number of things. They're based on life expectancy. They're based on market performance. They're based on rate of return. And they are based on interest rates. And there is an inverse, an opposite relationship historically between interest rates and the factors. So what does that mean? An opposite relationship. When interest rates are going down, the factors are going up. And when interest rates are going up, the factors are going down. So this year, for July 1st, the first of this month, we didn't get the new factors, and we don't get the new factors until the very end of June. I think we got them on about June 24th or 25th this year. And because interest rates this year are going up, the factors went down. In fact, the factors went down this year quite a bit, and it's the first time in a very, very long time that the factors have had a considerable decrease in them. The interest rate that's used to calculate is from a government organization called the Pension Benefit Guaranty Corporation. And last year's interest rate for the factors that applied from July of 21 to June of 22, it was about 0.6%. It was 0.61%. So the interest rate this year jumped considerably. For this fiscal year from July of 22, and these will apply all the way until June of 23, the Pbgc interest rate that applies to this year for the factors is 3.23%. So there was a big jump on the interest rate. So if you are perhaps a participant who registered for the portal back when we launched it a couple of months ago, and you pulled some estimates then, and now you've pulled new estimates for today's webinar, I'm sure that you will notice that that lump sum factor has changed. It has decreased. It's not a programming glitch or anything like that. It's just that the factors this year went down. Okay. So let's look at an example of a partial lump sum calculation. Okay. So we're back to our original example here. The carpenter is 60 years old, and his monthly base pension amount is $6,187.50. To calculate the maximum partial lump sum available, we take $6,187.50 times 10%, and we get the amount of $618.75. The new actuarial factor effective for this fiscal year, starting this July, is 177.2180, and that yields a partial lump sum amount of, excuse me, $109,600 and change. And I actually can't see past the 600. I do apologize. Part of my presenter frame on the webinar is covering that, but it's $109,600 and a couple of dollars. Just to give you an idea of the difference in the actuarial factors this year, when I did this presentation back in April using last year's factors, the factor that applied to this scenario was 209.0647, and the lump sum payment was $129,358. So you can see that there was a big change in those factors this year. So I actually don't want to keep dwelling on that. I want to keep explaining to you your pension payment options. So we've calculated the partial lump sum option, and then we have to adjust the monthly benefit. So if you're getting a chunk of money up front, the monthly benefit will be a lesser monthly benefit. So we take the $6,187.50 and we subtract from that the $618.75 that we have already converted to this lump sum payment. So the monthly pension benefit for this particular carpenter, if the carpenter elects to take the lump sum option, the monthly pension on the 60-month guarantee single life annuity is going to be $55.68 a month instead of $61.87 a month. So it's a 10% decrease on the monthly amounts because of the lump sum up front. Okay. The lump sum is also available with the joint and survivor factors. So how we calculate now is we take this adjusted 60-month guarantee amount and we bring that down into our table. So the joint and survivor factors are the same as if the carpenter had not taken the lump sum factor. So we multiply the new 5568 by the appropriate factor, and we get the adjusted monthly benefits that the carpenter and the surviving spouse, could expect to receive during their lifetimes if the lump sum option is elected. Now, there are several ways we can pay the lump, and I'm going to talk about those in future years. There's a question coming through from Paul. And Paul, yes, the actuarial factors do change each and every July, and occasionally at other times as mandated by federal regulations. There's only, again, I've been with the fund office for 34 years. The partial lump has been an option since 1995. I can only remember one other time that the factors changed off cycle. They changed in March once, and I want to say that that was maybe in 2003, 2002. But in general, it's a July change date. But we follow the federal government's regulation on when the factors have to change. Okay. So on your personal individual estimates, you can see the factors that apply to you, the money that applies to you. If indeed you have printed out your estimates at home, I would suggest you put the two estimates side by side so that you can kind of see the difference in the monthly benefits that would apply if indeed you choose to take the partial lump sum payment option. Now, this partial lump sum payment option in our example here, that's the maximum partial lump that is allowed, okay? And the partial lump can be a lesser partial lump. So you do not have to take this full 10% of your pension as a partial lump sum. You can say, well, the partial lump sum, that sounds like a good idea. I would like a little chunk of money up front, but I don't need this entire $109,000 up front. I want to maybe make sure that my car is paid off, and I want to make sure that I pay off my credit card balances. And oh, by the way, there's just a little bit of money left on my mortgage, not a lot, but I'd like to start retirement just fresh and not owing anybody any money. So I'm interested in a lump sum payment that's $40,000, or I'm interested in a lump sum payment that's $75,000. So you can play with those dollar amounts through the participant portal, because if you're taking a lesser lump, it will impact on the amount of your monthly benefit for the 60-month and for the joint and survivor benefits. So utilize that portal we worked so hard on the estimate screen on the portal. It automatically populates the amount on the screen where you're putting in the date that you want the estimates to be. It automatically populates with your full lump sum payment amount, but you can click into that box and you can change that lump sum payment amount and decrease it and play with a couple of different scenarios and options. A question came through and it asked, is everybody's actuarial factor the same? And the answer is no. We get one single new table of actuarial factors for July 1st, but the actuarial factor that applies to any individual is based on your age at the time your pension starts. So to see the different actuarial factors that would apply to you on the portal, enter different estimate dates, enter different anticipated pension start dates. Run an estimate for yourself for October, and you can see what the actuarial factor will be for your age on October 1st. And then run another estimate for January, and then you'll see what your actuarial factor will be for your age on January 1st. So there is one set of tables that applies to everyone, but the individual actuarial factors are based on your individual age in months and years at the time your pension started. A couple questions coming through on taxes for the lump, and I'm going to get to those on our next slides right now. So I'm going to move forward. So you have several different options on how your partial lump sum can be paid. Okay, we can pay that lump sum directly to you. Okay, if we pay that partial lump sum directly to you, it is added to your taxable income in the year in which you receive it. Okay, and the pension fund is required to hold back 20% of that partial lump sum amount, just like the withholding on your paycheck. The pension fund is not going to keep the 20%. We're going to take that 20% taxes withheld and we're going to send that to the IRS, just like the withholding on your paycheck. And then it's between you and the IRS when you file your taxes the following year as to what income tax bracket you ultimately fall into. So please, this is on your slide and I have this listed as important. Please, please, please take note of this. When I say the pension fund is required to hold 20% back from the lump sum if we're paying that lump directly to you, I am not telling you that the lump is taxed at 20%. The lump is taxed at whatever income tax bracket you fall into. So if you fall into a lower income tax bracket, maybe you're entitled to a refund of some of this 20% from the IRS when you file your taxes next year. If you fall into a higher tax bracket, maybe you're going to owe the IRS a little bit more. Maybe you're taxed at more than 20% when you file your taxes next year. Okay. Now, again, right now I'm talking about making payment directly to you. There are some rollover options, and I'm going to get to those in just a moment. Okay. So, especially if you're thinking of retiring at the end of the year, like you're thinking of retiring and starting your pension in November or December, you've had your working income for the entire year. That's part of your taxable income. And then if you're commencing your pension toward the end of the year in the fall or November, December, you're going to have this lump money if you choose to take the partial lump, that is. If we pay it direct to you, the partial lump money is going to be added to your active working carpenter income over the course of the year. And maybe your spouse also works outside the home and maybe your spouse has income too. So you're going to add all of those things together. So taking payment directly to you could potentially move you into a higher tax bracket. Now, the pension fund office staff is not allowed to advise. So I can explain your options to you, but I cannot advise you on what's the best option for you. Neither can anybody on the retirement benefits team. So you should think about talking to a tax advisor about what the best course of action is for you. So this particular slide was about taking the lump and paying the lump directly to the carpenter. You also have some rollover options that affect the taxability of that partial lump sum option. Okay, you can say, yes, I want to take the partial lump sum option, but I do not want it paid directly to me, the carpenter. Instead, I'd like to do a rollover. Okay, and this speaks to your question, Paul, that just came through on the chat. Okay, you can do a direct rollover to a traditional IRA at the financial institution of your choosing, or you might also consider doing a rollover of that partial lump sum option directly to your supplemental retirement plan through the fund. And John Hancock is the record keeper for that. So you do not have to roll your benefit over to your John Hancock supplemental plan. You can roll your benefit over to any financial institution of your choosing into a traditional IRA. If you do a rollover to a traditional IRA or John Hancock's what's considered a qualified retirement plan, there is no mandatory federal income tax withholding. Okay. The entire amount of the partial lump will be paid to your financial institution of your choosing or to John Hancock to go into your account. It is not taxed in the year that the deposit is made to your IRA account or your John Hancock account, but that money will be taxed as you make withdrawals from your IRA or from your John Hancock retirement plan. Okay. There is also an additional rollover option. You can also elect a rollover to a Roth IRA. Okay. A Roth IRA, if you're familiar, it's an after-tax vehicle. So if you're rolling your benefit to a Roth IRA at the financial institution of your choosing, that benefit would still be taxed in the current year, but it would not be taxed as you make withdrawals. Okay. So for additional information on a Roth IRA, you want to talk to your financial advisor, or you can go out to irs.gov on the web and you can look at IRS Publication 590 for additional details on rollover options. Okay. When you fill out your pension paperwork, one of the forms you're going to fill out will be this partial lump sum payment election form. Okay. There's a sample form in the handouts today. It's a couple of parts. So part A of the form, you tell us to start with whether or not you want the partial lump sum option. You in no way are obligated to take this partial lump sum option. So the top box is no, you don't want the partial lump at all. The middle box is yes, you want the 10% partial lump sum option and you want that full 10% converted to your partial lump amount. You don't want to take a lesser lump. You want everything you can possibly receive as far as the 10% maximum. The third box is the scenario where, yes, you want a partial lump, but you don't want your full 10%. So you have to check the box and you have to tell us how much money you would like to receive as your partial lump. If you don't want the lump, you just check the no box and you sign the bottom of the form. If you do want the lump, you need to tell us, are we going to pay the lump directly to you where you do not want to roll over anything to an IRA? Or yes, you want to take the lump and you do want to roll over to an IRA. That's the bottom box. Well, if you're going to roll over to an IRA, you have to tell us where to send that check, because we are going to send that partial lump sum check. If you are doing a rollover, that partial lump check does not go to you. It goes directly to the financial institution of your choosing, or John Hancock if you're going to send it to your supplemental retirement plan. So on this second part here, you're going to have to complete the name of the financial institution or fill in John Hancock as the receiving financial institution. There's also a third page to this form. If you are married and if you are going to elect the partial lump sum option, there is a third page to this form that your spouse needs to sign to consent to your taking the partial lump sum option. That is a federal regulation. It is not the plan saying that we need spousal consent. The plan is complying with federal regulations in requiring spousal consent. Okay. There's a few questions coming through on the chat, so let me look at this. Question came through about, can you split your partial lump option between rolling over part of it and having part of it paid directly to you? And the answer to that is no, you cannot. It's either all paid to you or all rolled over to an IRA. But you could do a rollover to the IRA and then you can withdraw some, or we can pay it all to you as a direct payment. And then you can do what's called an indirect rollover. So you could keep part of the money and roll over part of the money yourself by doing a rollover on your own. And I would suggest you talk to a financial advisor if you're interested in doing something like that. And another question's coming through. This partial lump sum option is completely separate from the balance that you have in your John Hancock supplemental retirement account. So the partial lump that we're looking at here today is in addition to any money that you might currently have in your supplemental retirement account. Okay. And just a follow-up question about a Roth. Yes, if you are rolling to a Roth IRA, the plan is required, the fund office is required to hold back 20% and send it to the IRS, just like the withholding on your paycheck. So a Roth rollover triggers 20% withholding. A traditional IRA or a qualified retirement plan such as John Hancock does not trigger any withholding. We pay the full amount to that Roth IRA. A couple questions about how early do you have to fill out the paperwork. You don't fill out this paperwork until you actually apply for pension, and we will talk about timeframes for applying for pension as we go along in today's presentation. I have one more option to take you through called a level income option, and then we're going to take a break. So if you give me another 5 minutes or so here, we'll take a break. Okay. So the next option that is available to you if you are a participant in the construction pension plan is called a level income option. Okay. It is a way that you can receive part of a benefit for something that would resemble a Social Security benefit, and I'll explain it in the slides up front. And it's easiest to look at this if we do it in the slides. But this is an additional option, a level income option on the construction plan. If you are going to take the partial lump sum option, you cannot take this level income option, okay? Generally, people think about the level income option if they are retiring prior to 62, prior to Social Security eligibility age. So let's just dive into the examples here. And I am going to go through this a little bit quickly because it's not a terribly popular option. So after I explain this to you, and if you think you're interested in the level income option, you will need to get an estimate from the Social Security Administration of your estimated Social Security amount that you could draw when you're either 62 or when you're normal retirement age. So we suggest you doing that by going to ssa.gov on the internet, set up a My Social Security account. It's free, it's secure, it's through the Social Security Administration. You can receive a personalized benefit estimate for Social Security. In fact, even if you're not interested in this level income option, I assume everyone here attending today, you're interested in planning for your retirement. So this would also, registering on Social Security, give you a way to pull down your Social Security estimates because your Social Security benefits are in addition to any pension benefits payable from the fund office. Okay. Once you're receiving Social Security benefits, you can set up or change your direct deposit information online for Social Security. You can change your address for Social Security through their portal, all of these things. So for the level income option, in our example, the carpenter we're going to look at for this example is electing to retire and apply for pension at 60. She worked for 37 calendar years as a carpenter from 85 to 2021 and earned 42 years of pension credit. Never had a 3-year break in service. So 42 years of pension credit multiplied by $125 benefit accrual rate gives us a monthly benefit of $52.50 per month under that base 60 certain amounts. Okay. The level income option, the carpenter gives the fund office an estimate of her Social Security benefit from the Social Security Administration. And Social Security says that if she starts commencing Social Security at 62, her Social Security benefit will be $1,200 a month. So just like the factors used to calculate the partial lump sum option, there is another set of factors, another set of tables that also change every year on July 1st for these level income factors. So we take the $1,200 from Social Security, we look up the factor that applies based on her start age of 60 for pension and her start age for Social Security of 62, and that factor is 0.8687, and that gives us a level income amount The part of her Social Security benefit that the fund office is going to pay to her until her Social Security kicks in is calculated as $1,042.44. Okay. So the benefit that this carpenter is going to receive from the pension fund office when the carpenter's pension starts at age 60, it's the 60-month guarantee amount that the pension fund office sponsors, plus the carpenter will receive an additional $1,042 from the pension fund office. So basically part of the Social Security benefit the fund office will pay. We add these two numbers together and the carpenter draws $62.92 a month from the pension fund office from the time the pension starts at age 60 up until Social Security begins at age 62. Now, what happens when Social Security starts? Because right now, this sounds like a pretty good deal to me. Hey, I get extra money from the pension fund up front. Woohoo, sign me up. I'm in for that. Well, there's no free lunch in this world, and we all know that. So this is what happens after Social Security begins. In fact, 2 months after Social Security begins at age 62. So this full benefit of $62.92 that the carpenter is receiving from the pension fund office, we subtract off the entire Social Security benefit of $1,200. So that means that at age 62, the carpenter's benefit from the pension fund office goes down to $5,092 a month. Now, it's called a level income option because the carpenter is receiving $62.92 a month before Social Security starts, and the carpenter is still receiving that same amount, a level amount, both before and after Social Security. It's just a question of who's paying the benefit. Prior to Social Security kicking in, the full benefit comes from the pension fund. Once Social Security kicks in, $1,200 of that total comes from Social Security, and only $5,092 comes from the fund office. So you can see by electing the level income option, once Social Security kicks in, the carpenter receives $5,092 a month for the rest of the carpenter's lifetime, when had the carpenter not chosen the level income option, the lifetime benefit amount would have been $5,250 a month for the carpenter. Now, if you are interested in the level income option, you need to get an estimate from the Social Security office or from the Social Security website, and you need to send a copy of that estimate to the Retirement Benefits Department at the fund office. And the fund office team in the Retirement Benefits Department will generate estimates for you based on your individual situation. You cannot generate level income estimates on the participant portal because we need to verify your Social Security amount. Those need to be generated by the Retirement Benefits Department. However, please know that we, myself, and the team in the Retirement Benefits Department, we're more than happy to help you. So feel free to send in your Social Security estimate, to give us a call, to request level income estimates so that you can see the figures that would apply to you. Okay, so don't be afraid to call us just because there's the self-service portal now. You know, we're still here for you. We're still here to answer your questions. Okay, I'm going to take a quick peek at the chat and see if anything has come through. I don't see any questions right now, so let's take a break. It is 10:19 right now, and let's come back at 10:25. So go grab a coffee or do whatever you need to do. Let's take a 5-minute break. I'm going to start talking again at 10:25. If you'd like to, you can put some questions through the chat, and we'll look at those questions when we come back from break. Okay? See you back in 5. And we're back. So over the break, a few questions came through the chat, relatively simple questions. I tried to type back an answer for you. About 3 or 4 more involved personal questions came through on the chat. I need to ask you to please call the fund office next week for those more personal, more involved situations. It's not a forum where I can go into those details. Explanations for your personal situations here. But please know that we want to help you, and I strongly encourage you to call the fund office. We're nice people. We'll help you with your concerns, I promise. Okay? So getting back into the presentation, I'd like to spend a couple of minutes talking about disability pension. Carpentry is a tough trade, and we know that. You know, your knees hurt and your rotor cuff can be torn, and 100 other different things can happen. So we have a lot of inquiries regarding disability pension. So a participant will be considered disabled if you are unable to engage in any substantial gainful work activity. Okay, and it has to be for any type of employment. If you're just disabled and just not able to work as a carpenter, well, that is certainly relevant and is certainly a hardship, but it does not qualify you for a disability pension. In order to qualify for a disability pension, basically we employ almost the same requirements that the Social Security Administration does. Okay, you have to be disabled and unable to work at any type of substantial activity, which can either be physical activity or mental duties or a combination of both. Gainful activity is what the Social Security Administration calls any work that you perform and that you get paid for. So you have to be disabled if indeed you have a Social Security Administration Disability Award Letter. That's kind of the gold standard, and we take Social Security's word for it. And in a couple of slides forward, 2 slides forward, we'll talk about what happens if you do not yet have a Social Security Disability Award. So under the construction pension plan, you need, in addition to being disabled, you need to also have earned at least 15 years of pension credit. If you don't have at least 15 years of pension credit, you must have at least 10 years of pension credit, provided that you earned at least a quarter of a year credit in the year in which you became disabled or one of the immediately preceding 5 years. So that's under the construction plan. Millman Plan is slightly different. You need to have at least 10 years of pension credit, provided that you earned at least a quarter of a year in the year that you became disabled or any of the immediately preceding 2 calendar years. Okay. For disability pension required documents, as I mentioned a moment ago, if you already have a Social Security Disability Award Letter, you just submit a copy of your Social Security Title II Disability Award Letter to the Pension Fund Office, and we use that Title II Award Letter in lieu of any type of medical records or to any type of information from your doctor. So if you do not yet have a Social Security Disability Award Letter, along with your pension application, you will submit to the fund office medical records substantiating your disability claim. Those medical records are in turn sent over to the fund's independent medical consultant for review, and that medical consultant will determine whether or not your disability meets the plan's requirements for disability. Again, being disabled for any type of substantial gainful activity, not just for carpentry. Under a disability pension, there is no early reduction factor applied to the pension calculation. So under the construction plan, the benefit is calculated as if you're 60 years old. Under the Millman Plan, the benefit is calculated as if you're 65 years old. So you don't take any type of reduction for your age, no matter how old or young you might be when a disability begins. A disability pension is also payable as a single life annuity with a 60-month guarantee. And you do have the 50, 75, and 100% joint and survivor options available to you. The partial lump sum is also an option, but the level income option is not available on a disability pension benefit. Okay. For work restrictions on a disability pension, they're a little bit different than work restrictions on a non-disability pension, and we will talk about work restrictions for a non-disability pension in just another few slides. So for a disability pension, you are allowed to draw a disability pension and work in non-carpentry, non-building trade employment, but that employment cannot be what's considered substantial. And to determine substantial, the fund office employs the earnings limit that the Social Security Administration sets, and that earnings limit is adjusted annually. So the 2022 earnings limit is $1,350. Okay. That earnings limit, when it's adjusted annually, the fund office automatically ups the earnings limit that we allow. Sorry about that. I had a little glitch here with my computer. But we're back. Okay. If you are interested in a disability pension, the pension application form that is sent out for a disability pension is slightly different or slightly more involved than a regular pension application. There are some pages in there that you need to complete regarding your medical condition, your doctor, and things like that. I need to stop talking just for about 30 seconds, folks. I'll be right back, and I do apologize. I apologize, folks. Something happened here that we had to take care of. In these work from home days, you never know what's going on in the background with the husband or the kids or the pets. So I do apologize for that little slight delay there. Okay, pre-retirement death benefits. What happens if you pass away prior to commencing your pension benefits? Okay. If you are married and have been married for at least 1 year at the time of your passing, the construction pension plan provides for a 100% pre-retirement joint and survivor benefit. And that benefit would be payable to your surviving spouse in the surviving spouse's amount that is listed on the estimate you pulled down from the portal. You should be looking at the estimate without the partial lump sum payment. Okay, partial lump sum payment is not an option for a surviving spouse. The benefit is based on the estimate without the partial lump. That pension benefit for the Millman is a 50% pre-retirement joint and survivor benefit under the Millman Plan rules. Under both plans, your surviving spouse would start to draw a monthly pension benefit immediately following the carpenter's passing and would draw a monthly pension benefit for the lifetime of the surviving spouse, whether or not the surviving spouse remarries at a subsequent date. For the pre-retirement death benefit, if you are not married at the time of your passing, if you are at least early retirement age, and in the construction plan, that's age 55, and in the Millman plan, that's age 60, then the benefit would be paid as a pre-retirement 60-month guarantee benefit. So your designated beneficiary would receive a monthly pension benefit for 60 months for 5 years following your passing, and that benefit is calculated as if you went on pension the day before you passed away. If you are not yet early retirement age, and I'm going to move through this really quickly because there's nobody registered today that's not at least early retirement age, there are credit requirements surrounding a pre-retirement death benefit pension for an individual who is not yet, who is not married at the time of passing. So in the construction plan, they need at least 10 years with a half year of credit in the year they die or the immediately preceding year, or a total of 15 years of credit. In the Millman plan, at least 10 years of credit and at least a quarter year of credit in the year in which they pass away or the immediately preceding year. So total years of pension credit are multiplied by the death benefit rate, either the construction plan 875 or the Millman plan 345, and that resulting amount is divided out over 60 monthly payments. So for example, someone in the construction pension plan who had earned 10 years of credit all the way up until the point in time they passed away, we'd take those 10 years, we'd multiply by the $875 death benefit rate, and it's a total benefit of $8,750 paid out over a 5-year period. Again, I'm actually going to move on from that because no one registered for this webinar today was younger than early retirement age. So post-retirement death benefits. So the post-retirement death benefits for the monthly pension benefit, what happens after your passing is contingent upon the pension payment option you chose at the time you filled out your pension paperwork. Did you choose the single life annuity with the 60-month benefit, or the 50% or the 75 or the 100% joint and survivor benefits? So that choice is what determines what type of a monthly pension benefit will be available to your spouse or other designated beneficiary after your passing. In addition to that monthly benefit, that potential monthly benefit, if you are receiving a benefit from the construction pension plan, a pension benefit from the construction plan at the time you pass away, there is a one-time $3,000 death benefit that's paid. And from the Millman pension plan, there is a one-time $2,000 death benefit that's paid. For carpenters who are going to get a pension from both the construction plan and the Millman plan, because maybe you're vested in both plans or you've got your time split between both plans, you don't get a $3,000 plus a $2,000. You do not get a $5,000 benefit, but you do get the $3,000 benefit. So you get the greater of the two benefits that's paid out to your survivors, actually, not to you, but to your survivors at the time you pass away once you're already receiving a pension benefit. Okay. We will also talk about a life insurance benefit that is available as part of the retiree health benefit package, and we will talk about that when we get to the retiree health benefits. Under your active working carpenter health benefit package, you have, many of you know, a $50,000 life insurance benefit through, it used to be and now it's the Hartford. So that $50,000 life insurance benefit that is part of the active working carpenter health benefit package, that will stop at the time you lose your active working carpenter health benefits, when you retire and you fall below a certain number of hours. You can convert that to an individual self-pay policy directly through Hartford, and you would call the health benefits department at the fund office. The health benefits department, when you call in, is telephone menu option number 3 if you would like some information on converting that $50,000 Hartford benefit to an individual self-pay policy. It's not cheap. You don't have to buy the entire $50,000. You can buy it in $1,000 increments. So you could choose to buy, $5,000 in coverage, $10,000 in coverage. That premium is between what you elect, and the premium for that is really between you and the Hartford. You're moving to an independent policy with Hartford. You have 30 days after your active working carpenter health benefits end to make that conversion if you are interested. There is absolutely no obligation to convert that, but just be aware that that policy does end when your active benefits end. Okay. So beneficiary designations. We did not put this in the webinar email, and we will fix that for our next webinar. But to see the date of your latest beneficiary designation form for the construction pension, the mill pension, and even for your John Hancock for the supplemental retirement fund, the dates that you last designated a beneficiary, those are also available on the portal. So on the left-hand toolbar in the portal, you just click on the My Beneficiary section, and then this will come up and show you the dates of your most recent beneficiaries. These QR codes on the slides too, folks, those will take you right to the portal if you're interested or maybe haven't pulled down your beneficiary information or your estimates or your credits. That's what the QR codes are, and I apologize, I probably should have mentioned that earlier. If you see the word none on the beneficiary page, that means that you do not have a beneficiary form on file for that particular fund. Now, obviously, if you're a participant in the construction pension fund, there's no reason to be worried about not having a beneficiary on file for the Millman fund. But if you have a supplemental account, if you have a John Hancock account, you want to make sure that you have a beneficiary designated for that, and a beneficiary designated for whichever or perhaps both of the pension funds if you've participated in both pension funds. Okay. Speaking of beneficiaries, designating a beneficiary and keeping your beneficiary current is one of the most important things that you can do. You know, nobody likes to think about the day that you're not going to be here anymore, but you do want to make sure that you keep your information current. So if something unexpectedly happens and you pass, information will be on file so that your wishes are carried out, so that the pension fund office pays the beneficiary who you would like us to pay. So to designate a beneficiary or beneficiaries who will receive benefits on your death, the beneficiary forms are online at our website at carpenterbenefits.org. You can call the Retirement Benefits Department for forms, and they were included in the handouts for today's presentation. Okay, so print up a beneficiary form. You cannot do that online yet. We're talking about ways that you could, hopefully going forward at some point in the future, you'll be able to electronically go to the portal and designate a beneficiary, but right now you still need to fill out a paper form. So you can choose one or more beneficiaries as well as name contingent beneficiaries in case something happens to you. You can change your beneficiary designation at any time. If you're married, your spouse has to consent to your changes. Most of you, I would assume, would probably, if you are married, want your spouse to be your primary beneficiary. So on the beneficiary forms, which are two-sided, okay, you want to put your spouse on the front of the form as your primary beneficiary, and then you want to put your secondary beneficiaries, perhaps your kids, but it doesn't have to be your kids. You want to put them on the back side of the beneficiary form. Okay. Just a word of caution, perhaps, when designated beneficiaries, either primary or contingent beneficiaries. Some people say, oh, I want the kids to have it, and oh, we've got 4 kids, and I know that Johnny's a good boy, and he's going to split this benefit with his 3 brothers and sisters. Not a problem at all, and I know that Johnny will do that. Well, a couple of reasons you don't want to just name Johnny as your beneficiary or perhaps as your contingent beneficiary. You want to name each of the children separately and individually. 2 reasons. First reason is for taxes. If you name Johnny as the beneficiary and you anticipate Johnny is going to split that benefit with Susie, Tommy, and Joey, all of the beneficiary money becomes taxable income just for Johnny. So the IRS is going to tax the individual that the pension fund is actually making the payment to, even if that individual shares a benefit with the siblings. So list each of the kids separately, we'll pay each of the kids separately, and each of the kids will get their own 1099 tax form for when they file their taxes. Okay. A lot of times people get concerned during the presentation here when I'm talking about beneficiary forms, and inevitably I see something come through the chat that says, but I don't have a beneficiary form on file. What happens if I, get hit by a bus this afternoon? Well, there is an order of succession under the plan if you do not have a beneficiary form on file. So if you are married when you pass away, your spouse is automatically your primary beneficiary unless you've designated someone else with your spouse's consent. After that, if you are not married, or goodness forbid, if you and your spouse pass together, say in an automobile accident, second in order of succession is your children. Third would actually be your surviving parents. And fourth would be whoever you've designated as a beneficiary for that Hartford $50,000 life insurance policy under the health plan provisions. Please be aware that the fund office does not look at your will to see who your beneficiary should be. Nobody needs to send us your will. We don't want you to send us your will. Your will is basically irrelevant for purposes of the pension fund beneficiary process. You need to either designate a beneficiary using our forms, or we pay based on order of succession under the plan rules. Okay, so this is just what I talked about with the kids. You want to make sure that they're listed separately. In addition to taxes, you really never know what's going to happen after you pass. All the kids might get along very well right now, but you don't know what happens after you pass. My dad passed a few years ago. I have two brothers. We get along just fine, but after my dad passed, there was a little bit of tension about, who gets what and how this should be handled or how that should be handled. We worked it all out. We're still happy siblings who see each other on the holidays and chat now and then, but you just never know. So think about that. And I've actually already gone over what happens if they die without a designated beneficiary. This is the order of succession on your slides. Okay, I'm keeping an eye on a chat, and there's a question coming through about, can you list your beneficiary as an estate rather than a person? So yes, you could if you're not married, or if you are married, you could with your spouse's consent. A couple of things. If you are married, you should list your spouse as an individual person on the primary beneficiary section, okay? Because then your spouse gets a lifetime benefit for your spouse's lifetime. If you're listing as an estate or a trust or a living trust or a traditional trust, if you're listing that as your primary beneficiary, that benefit is only going to be paid to the estate or the trust for a 5-year period. So it behooves you to list your spouse, if you are married, individually as your primary beneficiary. But it is perfectly fine for you to list the estate or the trust or the living trust as a contingent beneficiary if you like to. In the name section, you'd list it as, the estate of, or the revocable living trust of John Smith. But on that form somewhere, give us the name of the trustee so that we know who to contact. And the address that you should list on the form should be the address of the trustee, not your address because it's your trust, because you will have passed and we will need to get in touch with the trustee. Okay. Those are all the questions I see regarding beneficiaries coming through the chat. I will keep an eye on that, and we will move on to applying for pension benefits. So when should you request and file your pension application? We recommend that you call the Retirement Benefits Department 5 months ahead of time to request that an application packet be sent out to you. Okay? You should think about submitting your completed application approximately 4 months ahead of time, ahead of when you want your application, you want your pension to begin. You can't do it any earlier than that, really, because pension packets are only valid for a 6-month period. And that 6-month period is in accordance with federal regulations. We are required to send out certain things to you, such as a written explanation of all of the joint and survivor options, some things about actuarial equivalency and benefits to possibly waiting to start your pension until you're a little bit older. Your options with respect to having the partial lump sum paid directly to you or paid as a rollover to a traditional or a Roth IRA. We are legally required to provide you with those written documents by the federal government regulations within 180 days of your pension commencement, which is 6 months. 180 days is 6 months. So you can't get a packet any earlier than 6 months. If you are thinking you want to start your pension right away, you want to start your pension as soon as possible, and we're already past the deadline that would have been in place for you to ask for an app 5 months ahead of time or to send your app in 4 months ahead of time, call the pension department and talk with a pension representative. Shorter time frames may be accommodated subject to the provisions of the plan, but you must apply for benefits prior to the start date of your pension. So in theory, it's possible for you to call the pension fund office, make an appointment, go in next week and apply for benefits next week and be entitled to August pension money. However, I guarantee you, you will not be issued your first pension check in August. You're going to have to wait until September or maybe even October to get that first check, but it could be retroactive to August if you file your application in July. So you must apply in the month before. You must apply the month before you want the benefit to start. So you have to apply in July to be eligible for August, or you have to apply in August to be eligible for September. We don't like you to do those shorter time frames because a lot of times people submit incomplete applications, or you submit an application that you got maybe 4 months ago, and by the time we go back and forth with you on, oh, you sent in your application but you didn't answer question 6 and you forgot to send your birth certificate, and we'll talk about those other requirements in another slide. By the time we go back and forth with you, your paperwork could be past the 6-month period, it could be out of date. It's just not a smart idea to leave things for the last minute. So I did see on the registration report that there were about a half a dozen people registered that put down things like ASAP for when you want to start your pension, or maybe listed August or September. If you're one of those people, you want to be calling the Retirement Benefits Department on Monday or Tuesday and talking with a retirement benefits representative about timeframes. Okay. A lot of people also, in response to the registration questions, indicated that you wanted to work until the end of the year, or that you were thinking of starting your pension for January. Now is the time to call and request an application packet for a January 1st start date. Now, this July month, because the $125 accrual rate happened for this July, it was our biggest pension month ever. We processed 181 pension applications for July 1st. Prior to this, our record was 103 pension applications in any given month. But January is always a very big month, so you want to apply with as much lead time as possible, because although the volume of applications goes up at times, for example, in this July month, and usually every January, for some people like to start the year off fresh. They like to be a retiree for January 1st. The number of applications go up in those months, usually January, and when the accrual rate goes up. But the Retirement Benefits Department staff does not increase in December to accommodate January pension applications. So Our existing staff needs to account for that uptick in applications, and we do, and we're happy to do it. We're here to work with you. We're here to meet your needs. It's just that the process goes smoother if you apply farther in advance. So please consider these timeframes. If you're thinking of applying for January, you want to call in August for an application, and I would suggest that you apply, beginning to middle of September for a January pension start date. Again, shorter timeframes may be accommodated subject to the plan rules. Just do it early, folks, and make it a little bit easier, make it go smoother for yourself. Okay. When we talk about applying for benefits, we talk about two different dates. We talk about an effective date and an award date. So the effective date is the date that you're first entitled to benefits, and the award date is the date that we issue your first pension check. In some cases, your award date might be later than your effective date. Case in point, the couple scenarios I just gave you, somebody right now wanting an August pension start date. Well, if you apply for benefits within the next week, we could still do an August effective date, but there's no way we're going to get you a pension check for August 1st. So an award date would be the month your first check is issued, and in some cases, it may include some retroactive months. So when you apply for pension benefits, you get a pension application packet from the fund office, you fill out that pension application packet, and you return it to the fund office. Along with that, you will need to submit some required documents, and copies are acceptable. Okay, for quite a long time, we required original documents, and then the pandemic hit, and we started taking copies because the fund office was closed and people were emailing in or mailing in their applications and didn't want to send in their originals. So we switched over to accepting copies, and we have maintained that rule. Copies are fine. So we need a copy of your county certified birth certificate as your proof of age. By county certified birth certificate, I don't mean the little commemorative one that you get from the hospital, like with the pictures of your footprints on there. That commemorative from the hospital, or a religious, say, baptismal certificate with your birth date on it. Those are not acceptable proofs of age. You want a county certified birth certificate. So if you don't have that yet, now's the time to think about contacting the county clerk in the county in which you were born and requesting a county certified birth certificate. We need a county certified marriage certificate. Again, not the religious certificate that you got from the church or the mosque or the synagogue or wherever you might have been married, but the actual county certified marriage certificate. A copy is fine, but it has to be a copy of the county certified. We also require a copy of a government-issued photo ID for the retiree, and if you're married, for your spouse. So a state ID, a passport, a driver's license. Question came through the chat. If you were born and or married outside of the United States and your documents are not in English, do we need a translation? Yes, we require a notarized translation. So you send a photocopy of the original and a photocopy of the notarized translation into the fund office for any documents that are not in English. Okay. Your first pension payment, and actually all of your pension payments, they're paid monthly and they're paid on the first working day of the month. Okay, so we pay the month ahead. We don't pay the month behind like Social Security does. So Social Security, you apply, and the check that you get in July is really for June. Okay, from the pension fund office, the check that you're getting at the beginning of July is for the month of July, and the check that you're getting at the beginning of August is for the month of August. Okay. We have mandatory direct deposits starting with your second monthly pension payment. Okay, you can go to any bank you want. You give us your banking information on the pension application forms. Your first payment will still be a paper check. And just like the federal requirements on the pension application process with the 180 days, The federal government also says that we are legally required to provide you with a pension book. It's called a summary plan description of all the pension rules and the prohibited employment work restrictions and the appeal procedures. There are all kinds of things that we are legally required to provide to a new pensioner at the time their pension starts. So all of those legal documents come to you in a big white envelope with your first pension check, okay? If you are electing the lump sum option, the partial lump sum option, and if we are paying that lump sum benefit directly to you, your lump sum payment will also be in that same envelope along with your first monthly check and all these legal notices. If you are rolling over your lump sum option to a traditional IRA, at the financial institution of your choosing, or to a Roth IRA, or even to John Hancock, that lump check will be mailed out at the beginning of the month separately from this big packet of information you're going to get, and that lump check will go by mail to the financial institution of your choosing. Okay. The fund office does not provide check stubs once you go direct deposit. However, on the participant portal, you are able to see each and every month the pension, basically like a check stub, a notice of a wire deposit, a bank deposit, and it shows your gross amount, any amounts withheld for taxes. It shows any amounts withheld for medical, retiree health premiums, insurance premiums, and it shows your net bank deposit. So you can see that all out there. The pension payment is federally taxable. You have not paid any taxes on this money. Your employer has contributed to the pension fund in accordance with the employer's collective bargaining agreement. So while you have contributed your blood, sweat, tears, long hours, and sore muscles to the trade, you have not paid taxes on the money that's in the pension fund. Okay? The employer paid in. It was not a deduction from your check. You have not paid taxes on this money, so it is taxable at the time you are receiving it. Whether or not you want us to hold federal taxes from your pension check is your decision. If you do not have us hold taxes from your pension check, you may need to file quarterly depending on your income bracket, so you want to talk with your tax advisor about that. At this time, and in fact, in the 34 years that I've been here, we do not deduct state taxes from the pension. Okay. Here in Illinois, at the present time, the pension is not taxable by the state. It is definitely taxable by the federal government, but is not currently taxable by the state here in Illinois. I cannot speak to other states, so if you're going to be moving to Tennessee or Texas or California or New York or wherever else your heart might take you, you want to talk with a financial advisor or find out from that state whether or not your pension benefit is considered part of your taxable income in that state, and you'd have to check with that state to find out whether or not you would have to file some type of a quarterly return, because there will not be any state taxes withheld from your pension. Questions coming through the chat. A couple of these I've already answered in my talking for the last few minutes. If indeed you submitted your marriage certificate or your birth certificate to the fund office several years ago or in prior years, do you need to resubmit it again? It depends on where you submitted, to what department you submitted. The Retirement Benefits Department at the present time is not able to view documents that you maybe previously submitted to the Health Benefits Department. So I would suggest that if you know you previously sent in documents, give the team at the Retirement Benefits Department a call, and we can look on our imaging system and we can see if the Retirement Benefits Department has access to those documents previously submitted. There has been discussion. I realize that sounds crazy. You sent it into the same fund office at 12 East Erie, but the Retirement Benefits Department can't see the Health Benefits Department information. It has to do with protected health information and security. We are looking at ways going forward that we might be able to change that, but at the present time, Retirement Benefits Department can't see anything submitted to health benefits. So give us a call. We can check and see if we have access to your documents. If we have them, then no, you do not need to resubmit them. Okay, I see a couple of questions about disability, and I will try and get back to that on the next break. Question about what percentage would be held for federal taxes. That depends on your income level and on the amount of your monthly pension. If you give the Retirement Benefits Department a call, we can send you out a printout of withholding under the current tax tables. Tax withholding has changed over the last couple of years. I used to be able to furnish you with a chart during these, when we were in-person seminars or during these webinars, but since the tax withholding structure changed under the previous administration, it's a little more difficult to do that. Your best course of action really is to talk with a tax advisor about how much they think you should have withheld. The Retirement Benefits Department can send you a printout of what will be held based on your monthly benefit amount, and if you're claiming, single with one, married with three, the number of exemptions you're currently claiming. But that is only a true statement through the end of this year. Then pension funds will be required to comply with the new tax withholding rules, again, that were implemented under the previous administration. Pension funds have not had to comply with that thus far. I believe the compliance date is January of next year. So it won't be as simple as, married with two exemptions. There's a different type of form that gets filled out. So those are all the questions I see coming through right now. So I'm going to move on. Benefit adjustments. So I have just told you that you should be applying for pension maybe 4 months in advance of your anticipated start date. The pension fund office, the retirement benefits staff, we work 60 days ahead of time. So the people that are going to start their pension for August 1st, they've already applied for benefits. People that were going to cut their first check for August 1st, they've already applied for benefits. Those applications have already been processed. And currently this coming week, they're going to our outside auditing firm so that the outside auditors can check our work and make sure we've done all the calculations correctly and make sure we've received all of the required documents. But for someone commencing benefits August 1st, who's going to work all the way until the end of July, we've already done the initial pension calculation, and that does not include any hours that someone might still be working in July. Those July hours are not due to the fund office to be reported by your employer until August 15th. So the hours worked in July due August 15th, hours worked in August due September 15th, and so forth. So it is possible that we've calculated someone's benefit based on, say, 30 years of pension credit, only taking into account hours that have been worked through June. So what happens is 3 to 4 months after your pension begins, the team at the Retirement Benefits Department goes back and rechecks your record to see if any additional hours have come in on your behalf after we did the initial pension calculation, and then we adjust your monthly pension benefit, okay? We make the full adjustment to your monthly pension benefit. No adjustment is made to the partial lump sum amount if elected. So if additional hours come in to give you an extra quarter year or an extra half year of credit, we do the calculation and we put that on your monthly pension check. We do not issue an adjustment to the partial lump sum pension checks. If indeed, and we're going to talk about prohibited employment rules, if indeed you are at least age 65 and in some cases 70.5, where you're still working in the trade and perhaps some employer contributions are still coming in on your behalf. Annual adjustments are made for those circumstances where you're getting pension, but maybe you're still working. And again, the next topic we're going to talk about is prohibited employment and working while receiving your pension. But know that if indeed you are working because you're 65 or older, you're still getting some contributions maybe, we make annual adjustments to the pension for any credit earned in the prior calendar year. Okay. Looking up Okay, I don't see anything else coming through on the chat about applying for benefits or the documents required. So let's talk about working, and specifically, to start with at least, what work you can't do or what you have to stop doing in order to start your pension. So to start your pension, the IRS regulations and the fund office rules in accordance with IRS regulations require a legitimate severance of employment. And this is a two-part criteria. So this means, number one, you have to stop working, you have to cease employment in any capacity with any employer who is signatory to the pension fund, and you must not have any intent to later return to employment with a signatory employer to the pension fund. Along with that, part two is that you cannot be working in any type of prohibited employment for either a signatory or a non-signatory employer. So it doesn't matter if you're doing a job that we consider prohibited, and we're going to look at types of employment in the next couple of slides. But even if you are, goodness forbid, working non-union, that is still considered prohibited employment. You can't work with the tools, even if it's non-union, and start your pension because that's considered prohibited employment. Okay. As far as number one, just backing up for a moment, you have to stop working for any employer who is signatory to the pension fund in any capacity at all. So if you're working for XYZ if you're working for XYZ Construction and they are a signatory employer, you want to start your pension, but you want to maybe drive a delivery truck for XYZ Construction. Well, driving a delivery truck is not prohibited employment, but you cannot do it for XYZ Construction because they are a signatory employer. A lot of times coming through the chat when I start to talk about prohibited employment and stopping work, sometimes someone will say, but I'm going to stop work now, but I don't want to apply for pension for another year or two or three. Is that okay? And the answer is, yes, it is okay. You do not have to start your pension as soon as you stop working. You don't have to start your pension until you're at least age, it depends on when you're born. If you were born in July of 1949 or later, you have to start your pension the April 1st after the year in which you reach 72. I'm going to say that again. If you were born July of I'm saying 49, but I'm doubting myself. Most of you registered here today. Let's do it this way. You have to start your pension the April after you reach age 72. The April after you reach age 72. If you're really interested in an exact date to make sure, if you think you're going to be working that long, give the Retirement Benefits Department a call, because I don't have the exact date in front of me today for the birth date. So a legitimate severance of employment. You have to stop working for an employer who's signatory to the pension plan. And it can't be a kind of wink, wink, nudge, nudge, like Bob's your boss, and you go up to Bob and you say, hey, Bob, I want to stop working because I want to start my pension, but I know, Bob, you want me to drive the delivery truck for you even after I stop working for the tools. So hey, Bob, we're going to say that I'm quitting, and I'm quitting my job, and I'm going to go down, I'm going to take a vacation and go down to Florida for a month, and then I'm going to come back, and you're going to rehire me as that delivery truck driver, right, Bob? And you and Bob kind of have this side agreement that that's going to happen. Well, that is not a legitimate severance of employment. You cannot do that and start your pension benefits. You have to stop performing services for a signatory employer and have no intent of returning to work for that employer or any employer who contributes to the pension fund. There is one exception to this, and the exception is if you are already age 65. You have to be 65, not 64, not 64 and 11 months, at least 65. And if you are working for a contributing employer, but not in a prohibited capacity, but not in prohibited employment, then you could start your pension. So if you are 65 and you are already working for XYZ Construction as a delivery driver, then you're okay. But if you're younger than 65, you cannot be working for any signatory employer at all. Okay. This gets complicated because it's plan rules combined with government rules. So I try and cover as much as I can here, and I know that it's a complicated topic. I would strongly urge you to contact the Retirement Benefits Department team and talk to somebody on the team if you are wondering whether or not you are eligible to commence your pension benefit, and whether or not you have to stop working based on your age and the type of employment that you're doing. So once your pension benefit starts, you are only eligible to continue receiving your pension benefit provided that you are not working in what we call prohibited employment. Prior to age 65, you cannot work in prohibited employment in any geographic location, anywhere, nowhere across the country can you work in prohibited employment pre-65 and still get your pension. If you're between 65 and 70 and a half, you are allowed to work in an occupation that's considered prohibited employment, and even for a signatory employer, as long as you work less than 40 hours per month. Okay, and that's called generally the 39-hour rule. It's okay to work if you're at least 65. It's okay to work as long as you are working less than 40 hours a month. We call it the 39-hour rule. Once you are 70 and a half or older, you can draw your pension and do any type of work you want for any employer you want. Okay. So I've been using this term prohibited employment, prohibited employment. Let's talk about some prohibited employment examples. And in the handouts today, there's actually a 3-page insert in the pension paper handouts. It's on about page 45 or 46 of that handout with more detailed information about prohibited employment. So some examples of prohibited employment, and this is not all inclusive, but just some examples. You cannot work with the tools. You cannot be a building inspector for a contractor. You cannot be a project manager or a supervisor or a superintendent for a contractor. In fact, prior to today's webinar, somebody emailed in a question about being a project manager, and the answer to that is no, you cannot be a project manager while you're drawing your pension. You cannot be an employee of the council or of our fund office or of the apprentice and training program or an employee of one of the local unions. You cannot be a member of the council's executive board. You can't be a delegate. You can't be a delegate to the Federation of Labor. You can't be a business agent, a trustee, or an officer at a local. Now, the trustees, a trustee of your local or an officer of your local, you can finish out your term in a non-paid capacity, but you can't run for re-election. Okay, so those are some examples of prohibited employment. Again, not all inclusive. Some things that are not considered to be prohibited employment: it's okay to be a building inspector for the state, for the county, or for a municipality. You can be an inspector for a home purchase or sale. You can do sales. You can work at one of those big box hardware stores, and you can sell lumber there, and you can sell, hammers or whatever, but you cannot be the person to go out and do the installation. Okay. So some of those big box hardware stores, for example, they sell cabinets. It's okay for you to be the salesperson on their sales floor, but you cannot be the individual that they are sending out to do the installation of the cabinets at someone's home. It's okay to work picket duty. It's absolutely okay to volunteer in a capacity in which you're not getting paid. So maybe you want to do some work for your church, or maybe you want to do some work with Habitat for Humanity. You want to volunteer your time and use some of these excellent skills that you've honed as a carpenter. You can do that in a volunteer capacity where you're not getting paid. It's okay to be a draftsman or a computer-aided designer. You can be a safety director. You can start drawing your pension if you're an owner of a business, an owner of a construction business, if you are a passive owner and you have no active management responsibilities. Basically, that means if you own the company and you're down in Florida and the company's here in Illinois, you're down in Florida or out in Arizona playing golf, and you've got somebody else running the company for you up here in Illinois, and you're not involved in that company, you can draw your pension. We don't make you sell your company, but you cannot be actively involved in that company if you're drawing your pension. It's okay to be a corporate officer if you're not working with the tools, and it's okay to be a consultant regarding the viability of a project. And again, at the bottom of the screen, this applies to both union and non-union work. Okay. Once you are on pension, if you're considering returning to work, or even if you're thinking about applying for pension and you're not sure if your current job would be considered prohibited employment, what you should do is send a written job description from your employer on the employer's stationery, on the employer's letterhead. Send it into the Retirement Benefits Department. List your job duties. The Retirement Benefits Department and the trustees will review, and we will get back to you in writing and let you know whether or not that job you're thinking of doing might be considered prohibited employment. Okay? Having it in writing protects you, and it protects the plan, because we're going to send a written determination back to you. So a couple of years down the line, we find out that you're working, and we say, well, you're not supposed to be doing that. That's considered prohibited employment, and we're going to stop your pension. And not only are we going to stop your pension, but you're going to owe us back all the pension money that you've received over the last couple of years, because you've been doing this work all along, and it's prohibited, making you not eligible for that pension benefit. And if your response to that is, well, I called the fund office and I talked to Joe at the fund office, and Joe assured me that this would be perfectly fine, you got a couple of problems there. The first being, there is no Joe employed at the Retirement Benefits Department at the fund office. And the second being, even if there was a Joe employed there, how do you prove what Joe told you a couple of years ago? So the written determination protects you and protects the fund office. A couple of questions coming through the chat. What about an estimator? It is okay to be an estimator. Again, you have to look at the age requirement and who you're working for. If you are working for a signatory employer, you cannot be an estimator for a signatory employer unless you are already age 65. So you can't be 60 years old, be an estimator for a signatory employer. Remember, it's a two-part test. It's not just, is the job prohibited, but it's, are you doing the job for a signatory employer if you are younger than age 65? Question about a different trade. A different trade is fine. A different trade is not considered prohibited employment. So, you want to go be an operating engineer, or you want to go be a plumber, that's okay. Prohibited employment definition, is it a federal rule or a rule of the plan? It is a plan rule in accordance with federal regulations. So it's sort of both. The severance of employment restrictions, they're plan rules, and those are in accordance with IRS regulations. In fact, sometimes people say, well, what IRS regulation? Well, it's section 1.041 of 1.401-1B of the IRS regulations about severance of employment. So, we have to comply with the federal regulations. A question coming through about how does the union police this? Occasionally you are asked as a retiree to fill out what we call a statement of pensioner. They go out on an annual or a semi-annual basis to a random group of retirees, and you need to fill out the questionnaire about whether or not you're working under penalties of perjury. And we also require you to authorize us to check your earnings with the Social Security Administration. If we see earnings coming through on your behalf through the Social Security Administration, we circle around and we contact your employer to ask the employer for a job description to find out what you've been doing. There's also other things. There's BAs and there's organizers out on the job sites. They see a retiree out on the job site or someone they think is a retiree, they report it back to the fund office. And we check it out. There have been instances where basically we get a report from one carpenter on another carpenter, and then we send out the statement and we require that you allow us to check your earnings to determine whether or not you're still eligible for the pension benefit. And yes, you have to comply under the plan rules with that request of ours that you fill out the forms for us to check your earnings, basically to prove that you're not working in prohibited employment. Otherwise, the assumption under the plan rules is that you are working in prohibited employment and your pension terminates and we seek reimbursements. Let's see, working for a non-signatory general contractor as a superintendent in another state. Another state is still considered, I'm going to back up for a second. The question about another state, I think I talked about in the geographic area covered by the plan. What I did not mention and should have, so I apologize, is that under the plan rules, the geographic area covered by the plan, it's not just Chicago and Illinois, and now that our council area, they go down, it goes down to St. Louis and out to Iowa and up to Wisconsin. It's not just that particular area, but it's also any area within the country that contributions could be transferred back, could be reciprocated back to the fund office under something called the International Reciprocal Agreement for Carpenters Pension Plans. So basically the geographic area of the plan, especially pre-65, is pretty much the whole country. Okay. What if you decide to live outside of the country? I'm really not sure how we would police that outside of the country, in all honesty. We have 16,000 retirees. That includes both carpenters and beneficiaries like surviving spouses. We have 16,000 retirees, and out of that, there are about 50 people, maybe less than 50 people, that are living outside the United States, where their pension payment is going outside of the United States. So it's not a common occurrence. Let's see what else we have here. What if you're working salary? Whether or not you're salaried or you're hourly does not matter. We're looking at who you're working for, if they're a signatory employer or not a signatory employer, and we're working at the type of employment that you're doing. So. There are a couple of other questions coming through the chat about prohibited employment that are more of a personal nature. Again, I encourage you to call the Retirement Benefits Department to go over those questions with the Retirement Benefits Department. Okay. The Supplemental Retirement Plan is our next topic, and we're just going to briefly talk about the Supplemental Retirement Plan. That's your John Hancock. Okay. So John Hancock is the record keeper for our Supplemental Retirement Plan. Sometimes people call the supplemental retirement plan the annuity plan or the SRP, or sometimes people still even refer to this as Putnam, because when we originally put in the supplemental retirement plan back in 2000, Putnam was the record keeper. Okay, we're talking about the same thing, we're just saying it differently. Okay, so your supplemental retirement plan right now is administrated. The record keeper is John Hancock. To request an application for benefits, if you're ready to make a withdrawal on that supplemental retirement plan, you actually would get that application for distribution directly from John Hancock. You can either call John Hancock at the number on your screen, or you can go to John Hancock's participant portal, register your account there if you haven't already, and you can request the application for a supplemental retirement plan distribution form directly on that participant portal. Currently, the contribution rate to the supplemental retirement plan for MARBA is $9 an hour in the Chicago jurisdiction. Other rates vary according to those other areas' collective bargaining agreements. So, it might be different for those of you out. For anyone, there shouldn't be anybody registered here today. Registered here today is just Chicago, but the rates could be different for someone, say, working out of Will County, or somebody working down in Peoria, something like that. The rates also vary for the Millman Pension Fund in accordance with each individual mill employer's agreement with the council. Some of those rates are, maybe $1.50 an hour or so. So if you are not sure what your rate is, give the contributions department at the fund office a call, and they can verify for you what your individual contribution rate is. So during your working career, you have limited access to the funds in your supplemental retirement plan. You are allowed to take distributions for hardship reasons. Some examples of hardship reasons would be to avoid foreclosure on the mortgage on your home, or to avoid eviction from a rental property that's your principal residence, to cover extraordinary medical bills not covered by insurance, to cover college tuition expenses for yourself, your spouse, or one of your dependents. There are additional reasons too. But most of you here today are probably interested in what happens to your supplemental retirement plan account when you actually stop working. Okay, you do not have to start withdrawing from your supplemental retirement account until you are of an age that you are required to receive a retired minimum distribution. For most of you, that will start the April after you turn age 72. And John Hancock will be in touch with you if you still have a balance at that time, if you have not started receiving distributions yet. When you actually retire, you stop working. If you would like to withdraw your John Hancock account, you complete the forms for distribution that you'll get from John Hancock. You send them back to John Hancock, and John Hancock cuts the check. John Hancock, you can do direct deposit. You would log into the John Hancock portal and set up your banking information right before you submit your application to John Hancock, and that check can actually be direct deposit to your bank account. If you are going to do a rollover to your own personal financial institution, and the way that this works is exactly the same way we talked about for the pension partial lump sum payment. Your John Hancock account can be paid directly to you, whereby it is considered taxable income in the year in which you receive it. And John Hancock has to hold back 20% for federal income taxes. Or you can do a rollover to the financial institution of your choosing, either Roth or non-Roth, and John Hancock will send that check. Actually, the check is made payable to the financial institution. This is a little different from the pension side. John Hancock actually sends that check to you, made payable to your financial institution on your behalf, and you send that check on to your financial institution. But John Hancock handles those distributions. If you are uncertain about your current Hancock balance, you receive quarterly statements. But I would encourage you to download the John Hancock app, or you could also access John Hancock on your laptop or desktop computer. You can see your balance. There's some nice financial calculation tools out there that help you check retirement readiness. And you can manage the account with the app. You can make investment choice decisions on the app, all of those types of things. Our presentation here on the supplemental retirement plan is relatively short because the supplemental retirement plan actually has its own webinar. So, okay, we're going to take our second break. Again, the QR code on the screen is the QR code that takes you to the portal. If you maybe didn't download your credits or your estimates, or you maybe want to check on your beneficiary designation dates, you can scan that QR code. And when we come back, we will talk about retiree health benefits. So it's 11:37 now. Why don't we actually take a little bit more than 5 minutes? Why don't we come back at 11:45? So I will start talking again at 11:45. Okay, and I'll watch the chat on the break if you want to set any questions through the chat. And remember, please, if I'm not answering your questions today, please, please, please call the fund office. We are there to assist you and to answer any questions that I didn't answer today, or any questions that are more pertinent to your personal individual situation or credit record. Okay, so I will start talking again at 11:45. Thank you so much. And we're back. It's 11:45. Thank you for sticking with me. A few people have dropped off, I can see, but most of you are still here. Just a reminder, we are recording this, and we will post that recording on the Fund Office website. It'll take about a week. Right now, the recording from the April webinar is posted. If you go to our website at carpenterbenefits.org, under resources, the top category is video library, and you will be able to see this. If you missed something I said, or again, if you have to drop off before we're done talking about health benefits, you will be able to access that recording. One thing I know that I forgot to mention, and then one other question that came through the chat while we were gone. First of all, to apply for benefits, to apply for your pension, you can either mail in your application through the post office, you can scan your application as a PDF, and you can email it in to the fund office. The email address is on the application itself. You can even fax it in. We still have faxing capabilities. And you have the option of coming into the fund office to apply in person, and maybe even to go over any other questions that you have that haven't been answered or addressed by the materials. If you're going to come into the office, two things. First, fill out as much of the application as you can at home. You don't need to come into the fund office to fill out your name and your address and your phone number. So fill out as much as you can at home before you come in. Of course, anything you have questions about, leave blank. And then the second thing, and even more important, is make an appointment. Okay, the fund office is open. We've been open since I'm pretty sure last June, I think, is when we reopened after the COVID. But make an appointment. There's some days that we have limited staff in the office. You can make an appointment for the downtown, for the Chicago office up on Erie Street. And on Tuesdays and Thursdays, we have appointments available out on the Lyle campus, where the Vision Center and the Health Center and the Union offices are. But make an appointment in advance, especially for the Lyle office, because on Tuesday and Thursday, those Lyle office appointments go, and they're hopping and they're busy. Downtown in the Chicago office, we're busy too, but we could possibly accommodate a walk-in in the Chicago office, but it's better if you have an appointment. You're set up, you have a rep designated to go over the information with you, to accept your application from you. If you're coming in person, and if you don't want to deal with making copies of your marriage document, your birth document, bring your originals with you into the office. We will make the copies, and we will give your originals back to you right there in the fund office. Coming in for an appointment, you and anyone accompanying you, maybe your spouse or something, you want to make sure that you have your government-issued photo IDs with you, your driver's licenses with you. We need those for anyone that we're going to see for an in-office appointment. The second thing I wanted to mention before I start talking about health benefits is actually a second question just came through the chat. Do we have a multi-language representative? We do have Spanish-speaking representatives in the Retirement Benefits Department. We did have one gentleman who could do Polish translation for us. His name was Rich. He was a wonderful guy, but he himself just retired last year. So we do not have a Polish translator in the office. So if you would like to come in or speak with us on the phone, if you could have someone that you know translate for you. If not, we do have a translator service. We can kind of do a three-way call with a translator service to translate into Polish. So that is another option. The other question that came through the chat is, once you start receiving your pension, is there anything that would change the amount of the pension? So I assume you're talking about the full amount, the gross amount of the pension, and I would like to mention that the pension does not have any automatic cost of living adjustments built into it like Social Security does. So it's not like every year you're going to get a percentage increase of X percent. At certain times in the past, the trustees have decided to grant increases. and or perhaps bonus payments. So the last increase to monthly amounts was back in 2019, and the percentage increase really depended on how long you had already been retired. Some of the retirees who have been on pension for a very long time, at the beginning of the presentation, if you were here at the very beginning, I mentioned that our longest retiree has been on pension for 42 years, and he's 97 years old. His monthly pension benefit is only $460 a month because he retired so long ago when those accrual rates were so much less. So several of the increases and of the bonuses have purposely been designed by the trustees to give those folks who retired longer, such a long time ago, who have such a low pension, to give them the greatest financial boost. Pardon me. So the 2019 increase for those who had retired prior to 1999, it was a 10% increase. And then it was graduated 10%, 6%, 4%, 3%, and then it was a 2% increase for people who retired between 2015 and 2019. There have also, prior to that, the most recent increase prior to that was in 2007. There was an increase of 1.5% or $50, whichever was more. The year before that, in 2006, there was a 1.5% increase or $25, whichever was more. Prior to that, it was a January of 2002 increase. So permanent increases have not really been an ongoing, consistent thing. What happens quite often, though, is a bonus check, and sometimes it's a 13th check equal to one extra payment, and then sometimes it's a calculated bonus, again, sometimes formulated in such a way as to give those folks retired such a long time ago with such small pensions a larger benefit. So in March of this year, in March of 2022, there was such a bonus. We took your years of pension credit and we multiplied your total years of pension credit by $21. And we took how many years you had been on the pension rolls and we multiplied that by $75. We added those two numbers together for a one-time bonus payment that was issued in March of 2022. There were also bonus payments in March of 2018, March of 2017, and going back. If you're interested, we can give a full listing if you call the pension fund office. Question coming through the chat in conjunction with this is, has there ever been a decrease? There has never been a decrease in the monthly pension benefits being paid out from the pension fund office. There are something called anti-cutback measures that are government regulations, that apply to pension plans, and the trustees can't just randomly decide to decrease pension benefits. A caveat to that would be there is something called the Pension Benefit Guarantee Corporation. If the pension plan were ever basically to go bankrupt, there are provisions under this Pension Benefit Guarantee Corporation, which is basically sort of a pension insurance company. There are provisions that a pension would continue, but perhaps in a lesser amount. But your pension benefits are not in jeopardy. I would like to make that very clear. In fact, the pension fund, the construction pension fund, was doing so well that the trustees were able to make this historic accrual rate increase from $100 up to $125. The construction pension fund currently has a little over $4 billion in assets. And prior to the $125 increase was actually funded at 108%. The Millman Plan, pardon me, talking too much here today. The Millman Pension Plan is funded at about a little over $90 million, and it's approximately 76% funded. So, both pension plans are in good shape, and I really wouldn't be worried about the plans, declaring bankruptcy anytime soon. So that's all I see coming through the chat. A couple questions about pensions and taxes. I provided pension tax information already. So I'm going to move forward because we're now almost at noon and we still need to talk about retiree health benefits. So I would guess that we'll probably be ending about 1 o'clock, maybe 1:15, just to give you an idea, but I guess it depends on how many questions come through. Remembering if you have to drop off, you can always view the recordings. Okay. So as we talk about retiree health benefits, we're going to talk about eligibility requirements. We're going to talk about what happens when you're still eligible for the active health plan benefits at the time your pension starts. We'll look at premiums. We'll talk about postponing enrollment, types of coverage available, some additional benefits that don't fall under like the Blue Cross Blue Shield umbrella. And we'll talk about the Carpenters Centers for Health and Vision out in Lisle and about prescription drug benefits. So in order to be eligible for retiree health benefits, you must have at least 10 years of eligibility service to be eligible for benefits. However, if at some point in time you did not earn any credit for 3 consecutive years or more, kind of like that calculation break rule we talked about earlier, then you need at least 15 years of eligibility service. So for most people, eligibility service is equivalent to your years of vesting credit. So if you look at that credit printout that you pulled down from the participant portal, you can see how many years of vesting credit you have. The only time eligibility service is not equivalent to vesting credit is if at some point in time you worked for a contractor who was only contributing to the pension fund where you did not have the active health benefits. The contractor, the signatory employer, was only signatory to the pension plan and not to the health fund. So for most situations, you can look at your years of vesting credit to determine your years of eligibility credit for the tiered premiums that we're going to look at in a couple of slides. If you are eligible for active working carpenter health benefits at the time your pension starts, there are 2 different scenarios based on whether or not you're eligible for active benefits. So the first scenario, you're not eligible for the active health plan of benefits at the time you retire. You haven't been working for a while. Your quarterly report showed no, you're not eligible. Or perhaps you just vested in the pension plan and you left and you've been doing something else for the past several years and you're no longer actively working as a carpenter here. You can begin your retiree health benefits at the time your monthly pension check starts on your pension award date. So if you're not eligible for the active carpenter health benefits, your pension begins on the date of, your retiree health benefits begin on your pension award date. If you are eligible for the active plan benefits, your eligibility under the active plan will continue even though you're a retiree. Your eligibility under that active health plan will continue as long as you don't fall below 1,000 hours in the past 4 quarters. And we'll look at that on the next slide. So when you start your pension, of course, hours will stop coming in on your behalf. And that 4-quarter look back, you still maintain your active eligibility as long as you have 1,000 hours in the last 4 quarters that we're looking at. You don't have to do the math on that. We do that for you on your quarterly report. And you can actually now see that on the participant portal. When you log into the participant portal, you can click your active on the left-hand side, you click health plan and you can see your active eligibility. So you can see how long your active eligibility will go based on hours currently reported to the plan. So once you fall below 1,000 hours for the past 4 quarters, your active health benefits are going to come to an end. And at that point, there are two different scenarios. Your first scenario is the one most frequently elected. You move from the active benefits directly onto the retiree health benefits. Okay. And your next scenario is that you move from the active benefits onto something called COBRA continuation coverage, and then you move on to the retiree health benefits after that. Now, COBRA benefits, sometimes I think that there's something people think is kind of mysterious about COBRA. What's this COBRA coverage? Well, COBRA isn't really any type of different coverage. It's the same coverage that you had under the active benefits. COBRA stands for the name of a law. It's an acronym for a law called the Consolidated Omnibus Budget Reconciliation Act, and it was passed back in 1985. And what that law says is that when your active benefits end, and the active benefits can be ending for a multitude of different reasons, not just for retirement. Maybe you're a 40-year-old carpenter who just didn't work enough hours to have his active eligibility extended. It doesn't just have to be retirement. The COBRA law, the Consolidated Omnibus Budget Reconciliation Act law, says that when active benefits are going to end, the health plan needs to give you the option to continue those active health benefits, and you would pay for coverage, and you can do that for a maximum of 18 months. Okay. The COBRA rates for 2022 for an individual COBRA policy for one person, it's $681 per person per month. And it's $616 per person per month if you don't want to pay for vision and dental. So you could come from the active benefits, you could pay for those active benefits for another 18 months under COBRA premiums, or you could, and then after COBRA, you can move on to the retiree benefits. So active to COBRA to retiree, or you do not have to take COBRA. You can move directly from the active benefits onto the retiree benefits. So if you're not going to pay for COBRA and continue your active benefits under COBRA, then your retiree benefits will automatically begin the first of the month after your active benefits end. Okay. While you are still eligible for the active benefits, even though you're a pensioner, as long as you're still eligible for the active benefits, you do not have to pay anything for retiree health benefits because you're still covered under the active health benefits. You're not under the retiree health benefits yet. Okay. So once those active benefits end, what are the retiree premiums and what happens then? So this slide shows you the retiree premium chart, and this premium chart is also in the health benefit handout. It's the first page of the health benefit handout. Okay, so to determine what your retiree health benefit premiums will be, you have to do a little bit of math. Okay, so if you are not yet Medicare eligible, your major medical, your comprehensive medical coverage, which is your Blue Cross and Blue Shield, based on your years of eligibility service, so look at your pension credits that you pulled down from the portal. If you have 30 or more years of vesting credit, eligibility credit, your Blue Cross Blue Shield is going to cost you $187 per person per month, okay? Per person per month. So if both you and your spouse are not yet Medicare eligible, you're going to take, and you both want to be covered by the retiree Blue Cross and Blue Shield, you're going to take $187 times 2. One premium per person per month for each of you. So 187 times 2 if you're married and neither one of you is Medicare eligible. That's what your Blue Cross Blue Shield will cost you. If one of you, and it doesn't matter if it's the carpenter or the spouse, if one of you is already Medicare eligible, again, you find your years of eligibility service. If you have 30 years of eligibility service, if one of you, or maybe even both of you, is already Medicare eligible, then instead of paying the $187 a month, you're going to pay $47 a month for the Blue Cross Blue Shield, because it will be a secondary payer to your Medicare. So if you and your spouse are both Medicare eligible, it's $47 a month times 2 people. If one of you is Medicare and one of you is not Medicare eligible, then it's $187 for one person plus $47 for the other person. Okay. So the third category here on the slide is prescription drug premiums. Okay. So these first 2 columns are giving you, is what you pay for your Blue Cross and Blue Shield. And the column all the way on the right is what you would pay to have prescription drug coverage in addition to the Blue Cross Blue Shield. So for someone with 30 or more years of credit, the prescription drug premium is an additional $75 per person per month. So 2 of you covered, you both want prescription coverage, it's 75 times 2. Okay, so the first 2 columns kind of go together for Blue Cross Blue Shield, depending on whether or not you're Medicare eligible. And then this last column is for prescription drug coverage. So again, you have to do a little bit of math here. Some questions coming through the chat. When are you Medicare eligible? In general, you're Medicare eligible at 65, and I'm going to talk about pre-Medicare versus post-Medicare coverage after we look at premiums. Years ago, I used to look at coverage first, but all the questions coming through the chat, or when we were in person, everybody's hand went up and said, how much does it cost? So today we're talking about what it costs first, and then I'm going to talk about the coverage. I'm going to talk about Medicare coverage, when you become Medicare eligible, and how our plan works with Medicare. So give me a few minutes for that, please. These premiums must be deducted from your monthly pension payments. Okay? We don't have the staff or the capacity to send you a pension check and then to have you send us a premium check. So the premiums are automatically deducted from your monthly pension payments. As I already mentioned when we were looking at the chart here, Blue Cross Blue Shield and prescription drug coverage are separate options with separate premiums. Dental and vision coverage are separate options that we will look at on the very next slide, and they also have additional separate premiums. The premiums are subject to change. However, I will tell you that the trustees recognize that how much you need to pay for your health benefit premiums certainly has a direct impact on your retirement, your ability to retire, and your ability to be financially secure in your retirement. The premiums here that are shown here have been in place since 2011. There has not been a premium increase on the Blue Cross Blue Shield or the prescription since 2011. Now, that's not to say that the premiums will never increase, but for me to be able to tell you that there has not been a premium increase in 11 years, almost 12 years, really is testament to the fact that your trustees understand that the premiums and how much you have to pay for the premiums play an important role in your retirement financial security. Okay. So a retiree, the carpenter, must be covered by a benefit category in order for the spouse or the dependent to take coverage. And what do I mean by a benefit category? In order for a spouse or perhaps even a dependent child to be covered by Blue Cross Blue Shield, the retiree has to be enrolled in the Blue Cross Blue Shield. In order for a spouse or dependent child to be eligible to enroll in the prescription drug coverage, the retiree must be enrolled in the prescription drug coverage. Dependent children up to age 26 can be covered. You would have to pay a separate per person per month premium for your dependent child. Disabled dependents past age 26 may also be covered. Okay, so if you have a disabled dependent, there's some paperwork to be filled out and some eligibility requirements to be met. So there are some specific requirements around disabled dependent children and their ability to be covered. So you call the fund office, please, Retirement Benefits Department, if that is your individual situation to discuss. If the child is not disabled, they can be covered up to age 26. Okay. Medicare eligibility is on an individual basis. As I mentioned when I looked at the premiums, you and your spouse probably will not become Medicare eligible at the same time unless you were born in the same month and year. In general, you are Medicare eligible when you reach age 65. In some circumstances, you may be Medicare eligible due to disability prior to age 65. So I'm just looking, before I move on to the next slide, I'm just looking at a lot of questions coming through the chat. So premiums are deducted from the check. I already said that. I will talk about questions about, is this coverage the same as the active coverage? It's very similar. We will look at coverage after we get through the premiums. If you are trying to determine what tier and what eligibility you fall into here, you want to be looking at your vesting credit on your credit printout, not the pension credit. Those pardon me, those extra halves and quarters for the years that you earned the 1.25 or the 1.50 years of pension credit in the construction fund, those extra halves and quarters over the 1.0 are not counted toward these tiers. So look at your vesting credit on your credit printout to determine eligibility and to determine your tiered level on this slide here. Okay, a couple other questions coming through the chat I think that I will answer in subsequent slides. So let's look at our dental and vision premiums, and then we will talk about enrollment and coverages. So for dental, the retiree dental plan is through Delta Dental of Illinois, and this premium is in addition to the premiums we looked at on the prior slide for Blue Cross Blue Shield and for prescription drug coverage. So your dental premium for one person is $44.53 a month. For two people is $86.42 a month. And for family coverage, it's $153.33 a month. For vision coverage is through VSP, Vision Service Program, and that premium for one person is $6.20 a month, two people's $11.96 a month, and a family of three or more is $18.22 a month. So you do your math on the prior slide for how much your Blue Cross Blue Shield is going to cost you and how much your prescription coverage is going to cost you. And then if you want dental and vision here, you would also have to add in the premiums here for vision and dental. For vision and dental only, there is an open enrollment period. So if you do not take vision and dental when your pension starts, you can enroll on an annual basis. Open enrollment goes January 1st through March 15th, where you can fill out the forms and send them in, and then coverage would start April 1st. Again, the retiree must be enrolled in the coverage in order for the spouse or the dependents to enroll. So if you, the carpenter, don't take vision coverage for yourself, your spouse and your kids cannot have vision coverage. Same thing for the dental coverage. If you, the carpenter, don't take the dental coverage, then your spouse and your children cannot enroll in dental coverage. And on the vision and the dental, if you enroll in coverage, you have services, and then you cancel without being enrolled for a full year, you can't re-enroll during an open enrollment period for a 2-year period. Okay. All of the coverage elections are separate coverage elections. So you can choose, oh, I only want the Blue Cross Blue Shield, or oh, I only want the prescription coverage, or I want dental and Blue Cross, or I want prescription and vision, okay? Each of the coverages is a separate and independent election. So this is a snip of what the enrollment form looks like. So this Part B here is for the Blue Cross Blue Shield, the comprehensive medical benefits, either pre or post Medicare. So your Blue Cross Blue Shield is one election here on Part B. Then your next election is, do you want prescription drug coverage on Part C? Part D is for the dental, and Part E is for the vision. So you can choose yes and no in any given category. So you can pair however you'd like, or you're welcome to enroll in all 4 types of coverages if you choose to do so. The thing to keep in mind is what I'm showing you here is this is the carpenter, the participant election. There are separate election forms for your spouse and for each of your dependent children if you still have dependent children, okay? In order for your spouse and or dependent children to enroll in Blue Cross Blue Shield, you, the carpenter, must have Blue Cross Blue Shield. For the spouse or kids to enroll in prescription, you, the carpenter, must have prescription, and so on. So the spouse and the kids enrollment is contingent on the carpenter's enrollment, okay? A lot of questions coming through the chat that I think I'm going to get to, or that I actually already have gotten to. Okay. You do not have to, I'm going to move on to the next slide. What if you don't enroll in retiree health benefit coverage at the time of retirement? Well, you are able to enroll later. You can have a postponement and then enroll later, provided that whoever has postponed enrollment, be it the carpenter, the spouse, or a dependent child, you have to have continuous coverage with another health care plan. Okay, so if you postpone enrolling in the carpenter retiree health benefit program, your pension starts now, but you don't enroll for another 4 years in the carpenter's health benefit program. You have to have had other coverage during that 4-year period, and it can either be private insurance that you're paying for, or it can be insurance through a different employer. Maybe your spouse works outside the home and your spouse has coverage through the spouse's employer, and you're also covered by that. Okay, that's considered other coverage. Okay, so the other healthcare plan does not need to be an employer plan. It can be private insurance that you are purchasing on your own. Maybe Obamacare coverage through the marketplace, or maybe you've just gone out on your own and purchased a plan through another insurance company. After a postponement, the retiree health benefit coverage has to start immediately following the termination of that other health care plan. Okay. It is your responsibility to request enrollment forms before the other health plan coverage is going to end, and you want to send them into the Retirement Benefits Department at the fund office at least 30 days minimum, before coverage under the other health care plan ends. You will be required to provide evidence that you've had other coverage, or that if it's your spouse who postponed and you enrolled in retiree coverage as soon as your pension started, but maybe your spouse postponed enrolling in the retiree coverage, It is your responsibility to provide us with evidence of continuous coverage with another health care plan during any period of time that you or your spouse or your kids are not enrolled in the retiree health benefits. We have a form that you can get the other health benefit company to fill out, or you can provide us with maybe a certificate of creditable coverage that shows who was covered and the dates of coverage. Okay, so it's something to keep in mind while you're covered by the other plan. You know, statements that you get from the other plan, your annual 1095B health form that you use with your taxes. You know, save the evidence of coverage with the other plans. Save your certificates of creditable coverage. Save your 1095B forms so that you can provide evidence of coverage with the other plan. I'm going to take a look at the chat box here because there's a lot of questions coming through. So give me a second just to see what we've got here. Children who are not disabled can only be covered up to 26. Okay, so if you have a 27-year-old child who's not disabled, they cannot be covered. Only up to 26 unless the child is disabled. Yes, you can take dental and vision without getting Blue Cross Blue Shield. And I think the other questions either I've covered or I will cover. Okay. If you have questions that I am not addressing today, please, please, please remember you can call the Retirement Benefits Department. We are here to help you through this process. We understand that there's a lot involved in retiring and in moving from the active plan of benefits that many of you have had continuously for years and years and years, and now you're shifting over to the retiree health plan of benefits. So we understand that there's a lot involved, and we want to be here to support you and to answer any questions you might have. Okay. I'm going to move forward. So this is big news. As of 2019, surviving spouses can continue on the retiree health benefits under the same plan at the same premiums paid while the retiree was with us, or the same premiums paid by a retiree in case there's a premium increase in the future. Surviving spouses can continue on the health benefits for their lifetime, provided that they do not subsequently remarry. So this is a little bit different from the pension money, from the pension payment options. When we talked about the 50%, the 75%, and the 100% joint and survivor pension payment options, the pension money under a joint and survivor option, that continues for a surviving spouse's lifetime, whether or not the surviving spouse remarries at some point in the future. But the health benefits are different. If a surviving spouse remarries at some point in the future, the retiree health benefits will end upon remarriage. So you still keep the pension money if there was a joint and survivor option picked on the pension money, but the health benefits would not continue. Also, even if a married carpenter and spouse elect that single life annuity 60 certain on the pension money, where the surviving spouse is not necessarily going to get a pension check for the surviving spouse's lifetime, the surviving spouse would still be eligible to continue the health benefits. Now, since the surviving spouse would not be getting a pension check for the surviving spouse's lifetime under that 60 certain payment option, that particular surviving spouse will have to send a payment to the fund office for health benefits. But even if you take that single life 60-month guarantee option, on the pension side, the surviving spouse can still enroll in health benefits following the passing of the carpenter. Okay, So this was a great big change, an awesome change, a great benefit for the carpenters and surviving spouses. It happened in 2019. Prior to 2019, when the carpenter passed away, the surviving spouse was not able to continue coverage through the health benefit plan. Okay, I don't see any questions coming through the chat, so let's talk about coverage. I see a few people have dropped off of the webinar. Just a reminder again, this will be posted as a recording to the plan's website. So I'm going to take 10 seconds here and grab a drink of water, and then we're going to talk about coverage. Okay, so in the handouts, the health benefit handouts, starting on page 13 in the health benefit handouts, there's about a 10-page brochure. It looks like this. It's called Getting Ready to Retire. Now, the fund office sends out what we call summary plan description books, and they're about 100 or 120 pages, and they talk all about coverage and they give all the details. Well, I recognize that hardly anybody reads those 120-page books cover to cover. But this little 10-page brochure or so called Getting Ready to Retire that's in your health benefits handout, it's a really good, concise summary of the retiree health benefit coverage. And I really encourage you to take, 15 minutes or so to read over this little 10-page brochure that's going to explain your retiree health benefits, or at least the highlights of your retiree health benefits to you in a nutshell. Okay, so this is what the cover looks like. We're actually in the process of updating this. So if you call for a pension application in a month or two, the picture on the cover is going to look a little bit different. The layout's going to look a little bit different, but we'll still have this little, 10-page summary brochure to talk about your health benefits. So a couple questions came through the chat. Is the coverage on the retiree benefits the same as the coverage that you've had on the active benefits? And the coverage is very similar. We're going to look at coverage charts in just a moment, but something I want to point out to you up front, and it's just something important that so many people do not understand. Your active health benefits work on a quarterly basis. So your quarterly eligibility for the active plan starts March 1st and June 1st and September 1st and December 1st. So if you've been actively eligible, your retiree health benefits will start on March 1st or June 1st or September 1st or December 1st, depending on when your active benefits end. So if your active benefits were in place at the beginning of January because you were eligible for December, January, February quarter, and if you go to the doctor in January or February and you start to use the active plan services and you maybe meet your deductible in January or February on the active plan, and then in March your hours have run out, so in March you're moving to the retiree plan, you start over on the retiree plan with a new deductible. So as the slide in front of you shows, active plan deductibles and or any out-of-pocket towards your coinsurance maximums, they do not carry over to the retiree plan of benefits. Okay, it's very important to understand because sometimes people are surprised. They moved on to the retiree plan in March or in June or September and they've already met their active deductible, and they call and they say, but I already met my deductible. But when you move to the retiree plan, it's a new plan with new deductibles and out-of-pocket maximums. So that's something important to understand. Under the active plan, you have a network called Absolute Solutions where your radiology and imaging services are covered at 100%. The retiree program does not include the Absolute Solutions network. Now, imaging and radiology services are still covered. Okay, I'm not telling you you don't have coverage. You do have coverage still for radiology and imaging under the retiree plan. It's just that coverage is through Blue Cross and Blue Shield, and it's not paid at 100%. It's subject to the retiree plan, PPO, non-PPO deductibles, co-payments, things like that. Okay. Something else that is different once you move to the retiree plan, for the whole period of time you've been covered by the active health benefits, you've called the fund office for information on your claims and anything else that you might need, a question on your coverage. Blue Cross Blue Shield is your new contact for claims and coverage information once you move to the retiree Blue Cross Blue Shield coverage. You will get new retiree Blue Cross Blue Shield group cards, identification cards rather, with a new group number. Okay, your active group number, if you're actively eligible, you should know, or you can see on your card, your active group number is 50422. You'll get new cards on the retiree plan. If you're not Medicare eligible, your retiree group number is going to be 50445. And if you are Medicare eligible, your retiree group number is going to be 50446. You don't have to remember those numbers. You will get new cards. I just want to make sure you understand the retirees have different group numbers through Blue Cross Blue Shield. So Blue Cross Blue Shield is going to be your new contact person for information about coverage and claims. If, however, you want to add a new spouse or drop a coverage or add a coverage, or maybe your child is getting married and you want to take them off the coverage. So for changes in coverage, the Retirement Benefits Department will still be your contact person or your contact area, but the actual claims are handled through Blue Cross Blue Shield for retirees. Okay, let's talk about not Medicare eligible first. Okay, if you printed the slides for this, okay, I fixed this slide yesterday. So the slides you may have printed, the slides that were in your handouts, over here in the non-PPO column, you need to make two changes. If you printed things, make these two changes where it says purple, where the purple additional is, because the slides that were in the handouts had a typo on them. So I just want to mention that up front, that I fixed that part. So once you are on the retiree benefits, and maybe that's, if you're not actively eligible, that would be as soon as your pension starts on your award date. If you are actively eligible, it's when your active benefits end. Under your retiree plan, if you are not yet Medicare eligible, you have a deductible and a copayment just like you do under the active plan. And the retiree plan is a PPO plan just like your active plan. So if you're using PPO providers, just like your, pardon me, just like your active plan, you have a $300 per person per year annual deductible. If you have 3 or more family cover, actually more than 3 family members covered, so perhaps a carpenter, a spouse, and maybe you still have 2 children under 26 that you're going to cover, you actually have a $600 family deductible. If you are using non-PPO providers in addition to PPO providers, any claims incurred with the non-PPO providers have an additional $600 per person per year deductible. If you're using PPO providers, just like the active plan, it's an 80-20 split. 80% is covered by the plan, 20% is your responsibility. If you're using non-PPO providers, 60% of reasonable and customary charges, or sometimes called usual and customary charges, are covered by the plan. You're responsible for the other 40% and any amounts over and above the usual and customary allowances. Now, 20% sometimes can sound kind of scary when you know what hospital charges and what doctor charges are, but know that you have an annual maximum, an annual coinsurance maximum of $2,000 per person or $4,000 for the family. So if you have if at some point in time during the calendar year, your 20% adds up to $200 out of pocket, actually plus your deductible, so it's really $2,300 out of pocket, your coverage goes up to 100% for the balance of the calendar year. So as long as you're using PPO providers, your maximum liability per person per year is $2,300. $2,000 on your 20% coinsurance and the $300 deductible. Okay. If you're using non-PPO providers, you have a $6,000 annual maximum in addition. So if you're using both, you'd have a $2,300 maximum for PPO plus an additional $6,000 for non-PPO. You know, the Blue Cross Blue Shield PPO program has been in place so long for the carpenters, you know, for the fund office. I think most of us are used to using PPO providers where we're going to fall under the PPO deductibles and out of pockets. Okay. If you utilize an emergency room, if you are treated and released from the emergency room, you have a $250 copayment for the emergency room visit. That $250 copayment is waived if you're admitted to the hospital within 72 hours of the emergency room visit, or held in observation for more than 24 hours. There's a typo on this part down here too. If you're admitted to the hospital within 72 hours of the emergency room visit. So I apologize for that. I did not catch that one. Okay. So you can see as you look at this slide about coverage for those of you who are not yet Medicare eligible, that this coverage is extremely similar to your active working carpenter coverage. Okay, so the plan pretty much carries over onto the retiree side, just you have separate retiree deductibles and out-of-pocket maximums on an annual basis. Okay. Let's talk about Medicare, because the last slide we looked at, that's pretty easy to understand. You've been used to your active working carpenter benefits. You know what's covered and what's not, and what's not covered. Once you become Medicare eligible, and generally you become Medicare eligible when you are 65 years old, or if you are receiving Social Security disability benefits, you generally receive Medicare 2 years after your Social Security disability benefits start. Okay, so Medicare consists of two separate parts, Medicare Part A and Medicare Part B. And it's not so scary, I promise you. Medicare Part A is the part of Medicare that pays the hospital charges, pays the facility charges. Okay, and Medicare Part B is the part of Medicare that pays the professional fees, the doctor's office visit fee, what the surgeon charges to do the operation. It pays for laboratory tests, things like that. So Part A of Medicare is for the facility fees, and Part B of Medicare is for the professional fees, the doctor fees. Okay. You do have Medicare premiums. Medicare Part A, which is the hospital part, the facility part, for most people, Medicare Part A is free. You don't have to pay for Medicare Part A, provided that you have Social Security. Medicare calls it 40 quarters of work history. So basically, if you worked for 10 years, or if your spouse has worked for 10 years and you're covered under your spouse, Medicare Part A, the hospital part, is free. What you have to pay for with Medicare is the Medicare Part B premium. Okay. As of 2022, the Medicare Part B premium is $170 a month. Okay. So know that you are going to start paying for the Medicare Part B. You have to take Medicare when you are eligible. Your Carpenter Blue Cross Blue Shield will automatically become a secondary payer to your Medicare. You do not have the choice of staying with the Carpenter coverage once you're able and eligible for Medicare. Medicare must become your primary carrier. And although you're going to start paying $170 a month for the Medicare Part B, Your carpenter's plan, Blue Cross Blue Shield premium, is going to go down. I mean, think back a couple slides to the premium slide where we had the 3 columns for non-Medicare eligible and Medicare eligible. If indeed you had 30 years of eligibility service and you were paying $187 a month for the carpenter's Blue Cross Blue Shield pre-Medicare, that $187 premium goes down to a $47 Medicare supplement premium. So using that 30-year tier as an example, you're going to get $140 back on your pension check, but at the same time, you're going to start paying Social Security, usually deducted from your Social Security check, $170 a month for the Medicare Part B premium. So the $170 that you have to pay to Medicare is partially offset by the amount that your carpenter retiree premium decreases. So what's the coverage once you're Medicare eligible? And Medicare is your primary carrier, and your carpenter's Blue Cross Blue Shield pays secondary to Medicare. Okay. Well, on Medicare, it's still divided into 2 parts for coverage. Medicare Part A is the hospital coverage, and Medicare Part B is the doctor, the professional fee coverage. So on Medicare Part A, if you are admitted to the hospital and you are a bed patient in the hospital, Medicare Part A requires a deductible of $1,556 for 2022. Your carpenter's Blue Cross Blue Shield supplement pays that Medicare Part A deductible. And after that Medicare Part A deductible, that covers the first 60 days of care in the hospital. For most people, you're not in the hospital anywhere near 60 days. But if indeed you are for some reason in the hospital 60 days or longer, Medicare starts to require a copayment of $389 per day. Your carpenter's Blue Cross Blue Shield Medicare supplement pays that copayment. So on the hospital facility part, between Medicare and your carpenter's coverage, you have full coverage. You have 100% coverage. On the Medicare Part B, again, that's the professional fee, the doctor's office visits, or what the surgeon charges to do the operation when you're in the hospital, what the physical therapist charges, for you to go to physical therapy. Medicare Part B has a deductible of $233 per calendar year before Medicare starts to pay the professional fees. Your carpenter's Blue Cross Blue Shield Medicare supplement pays that Medicare Part B deductible. Now that's new. That started in 2019 also. Prior to 2019, the carpenter had to pay that Part B deductible. But now your carpenter's plan covers that. After the Medicare Part B deductible, Medicare is going to pay 80% of the Medicare approved amount, and the plan is going to pay the remaining 20% of most Medicare approved expenses. Now the word most usually causes some worry here, but what do you mean by most Medicare approved expenses? Well, the plan covers most things that Medicare covers. In fact, off the top of my head, the only thing I can think of that Medicare covers that the plan doesn't, and there certainly may be more, I'm just telling you the only thing I can think of off the top of my head that Medicare covers in circumstances where we don't, is gender reassignment surgery. So it's a very comprehensive plan between Medicare and your carpenter's Blue Cross and Blue Shield Medicare supplements. Additional benefits. Provided that you elect to enroll or you enroll your spouse and your kids in the retiree comprehensive medical or Medicare supplement, that's the Blue Cross Blue Shield, either pre or post Medicare. You also have coverage for chiropractor, acupuncture, and napapathy care. A maximum number of visits are on your screen per year. You also have hearing coverage, provided that you have retiree Blue Cross and Blue Shield. Okay, hearing is through the Epic Hearing Network, or you can use a hearing provider of your choice, and they can submit claims to Blue Cross Blue Shield. Your hearing exams are covered at 100% up to $150 once every 2 years, and hearing aids are covered at $5,000 every 5 years. That also is a big benefit improvement. Prior to 2019, there was no coverage for exams, and hearing aids were only covered at $1,500. Actually, speaking of hearing aids for $1,500, if you happen to have a dependent child younger than 18, hearing aids are covered at $1,500 and not the $5,000. Okay. Again, this chiro, acupuncture, and napapathy and hearing, you must be enrolled in the Retiree Blue Cross Blue Shield to be eligible for those benefits. If you don't take the Blue Cross Blue Shield, maybe you just take prescription or you just take the dental or the vision, you don't have these two benefits, nor do you have these other two benefits here now. Lyra Health is our new mental health partner vendor. Under Lyra Health, you can get mental health care when, how, when, and where you need it. The retirees, spouses, and dependents who are enrolled in the Retiree Blue Cross Blue Shield have access to 12 completely free mental health sessions per year, and even after those 12 sessions, mental health coverage is part of the Blue Cross Blue Shield benefit paid at the 80/20 coverage. For the carpenter, the participant, not for a spouse or a child, but for the carpenter participant in the plan, provided again that you've elected the Blue Cross Blue Shield, you have a $25,000 life insurance benefit through the Hartford. If you pass away, pardon me, prior to your 65th birthday. One moment, please. Oh, I apologize. Too much talking here. So if you pass away prior to your 65th birthday, you have a $25,000 life insurance benefit through the Hartford. Once you reach age 65, this $25,000 life insurance benefit does go away, but like the active benefit through Hartford, you can elect directly through Hartford to continue that on a self-pay basis. You don't have to buy the whole $25,000. You can pick up coverage in $1,000 increments. That would be directly between you and the Hartford. The plan doesn't, make any money on those premiums or anything like that. It's strictly a benefit available to you through the Hartford. Okay. Provided that you are enrolled in the Retiree Blue Cross and Blue Shield coverage, you have access to the Carpenter Center for Health out at the Lisle campus. This is both pre and post Medicare. So if you are using or wish to try the Carpenter Center for Health out at the Lisle campus, services are completely free at the health center, provided that you're enrolled in the Retiree Blue Cross Blue Shield. Carpenter's Vision Center out at the Lisle campus, provided that you are enrolled in the retiree vision coverage, you can also use the Carpenter Center for Vision out in the Lisle office. Okay. We're getting close, almost at the end, folks. Thanks so much for sticking around for the full presentation. Prescription drug benefits. I'm going to go over this pretty quickly because this is the same as your active plan of benefits. So everyone covered under the active health plan is very familiar with the fact that you can get a maximum of 3 fills of maintenance type long-term medications at your retail pharmacy. After you have 3 fills of a maintenance medication, which would be like a cholesterol medicine, blood pressure medicine, something like that. After you get 3 fills at a retail pharmacy, you must move either to the Express Scripts home delivery program or to your local Walgreens to pick up a 90-day supply. Now, things such as antibiotics or a one-off prescription, of course, you can still get those at a retail pharmacy. You don't have to use the mail order program or the Walgreens program for a short-term fill for a prescription that's just filled once for a certain condition. And this is the same under the retiree plan and the active plan. As far as your costs, the actual deductibles themselves, the actual co-payments themselves are the same under the retiree plan and the active plan. For a generic drug for a 30-day supply at retail, you have a $5 copay. Home delivery on maintenance medications or getting maintenance medications for a generic at Walgreens is $12.50. You have a 20% copayment on a single source brand drug where a generic does not exist. And you have a 35% copayment on a multi-source brand where a generic does exist, but for whatever reason, either you or your doctor wants the brand name coverage. We also have Accrual Pharmacy for our specialty drugs. Specialty drugs are generally injectables. They're used for chronic and complex conditions, cancer, hepatitis B, rheumatoid arthritis, and a variety of other conditions such as that. For specialty drugs, you have to obtain those just like under the active plan through Accrual Specialty Pharmacy. You have a 20% copayment with a $20 minimum and a $100 maximum, and that is for a 30-day supply through Accrual. That might sound like a lot, a $100 maximum on a 30-day supply, but specialty drugs, the average cost for the fund per prescription on a specialty drug is almost $4,000 per prescription for a 30-day supply. So even though it's a $100 copayment maximum on a specialty, it's still a very reasonable copayment when you consider that specialty drug, and again, $4,000 for a 30-day supply is an average of a specialty drug. So again, these coverages here, the coverage amounts here are the same as under the active plan of benefits. I almost always get questions about union dues. Do I have to keep paying my union dues once I'm a retiree? You need to contact your local union to discuss retiree dues. As long as you pay your union dues and remain a member in good standing, even as a retiree, you can continue to use up any balance that you might have on your HRA card through Optum Financial. You can even use that HRA card to cover retiree health benefit premiums. Now, we still have to deduct your premiums from your pension check, but you can print out your printout from the portal of your retiree premiums, or you can contact the Retirement Benefits Department for basically a receipt that you've paid your retiree premiums from your pension check, and you can submit to Optum for reimbursements of those premiums for any remaining balance you might have on your HRA card, as long as you're still a member in good standing with the local. Also, remaining a member in good standing lets you take advantage of the Midwest Coalition of Labor Members Only benefits, and that Members Only benefit booklet was one of the handouts in today's handouts for the presentation. I will get back to the chat box for any questions, but for those of you who have to drop off, I just want to mention a couple of things. So if you've asked a question in the chat box, just give me a minute, I'll get back to that. But if you have to drop off, please, I would appreciate it if you would take a couple of minutes, and really that's all it's going to take you, maybe 2 minutes to complete the survey. Either after you close the webinar, the survey will come up, or if you don't have time right now, there'll be a follow-up email sent to you either tomorrow or Monday for the survey. Again, please remember to let the fund office know if there's any changes in your circumstances. Call us with your questions, call us with your concerns. We're there to help you. We're there to support you. And with that, I am going to pop back to the chat box to see what we have here in the chat box, because I do not have any more slides to go over. Not too many questions that I haven't already covered. And again, if I'm not answering your coverage in the chat, think about going back to watch the video library on the plan's website on the video library page under resources. Can I provide a link for the Getting Ready to Retire brochure? That's in your handouts for today's seminar, webinar. If you did not get that, if you give the fund office a call, the fund office can email you a copy of that Getting Ready to Retire brochure, and they can even email you the handouts if you, for some reason, can't access them through the emails that you've already received. They can also be mailed out to you, so just give the Retirement Benefits Department a call. Private insurance coverage. I do not see any additional questions about the health benefits. There is one question here about taking benefits. If you haven't started your pension yet and you pass away, what benefit will the spouse receive? Under the construction pension plan, it is a pre-retirement 100% surviving spouses amount. So look at your estimates that you downloaded for today. On the construction plan, pre-retirement death gets the surviving spouse a 100% joint and survivor. On the Millman plan, pre-retirement spouse would get the amount listed as a 50% joint and survivor. A couple questions, in fact, 2 questions about being divorced. Give the fund office a call. You want to ask to speak with Heather. Her name is Heather in the Retirement Benefits Department. She's our sort of divorce guru. The proper term is a qualified domestic relations order, and she's our quadro analyst. So for the divorce questions, please call Heather at the fund office. Questions about potential future accrual rate increases. I have no information on that whatsoever, Matthew. And Gregory, yes, the retiree health benefits work in all of the different states. It's just if you're at a hospital, in Florida or Arizona or New York or something, when you present your card, make sure you're telling the hospital that that's Blue Cross of Illinois. Hospitals should be able to tell that from your group number. But just mention it, because if that hospital bills Blue Cross of Florida or New York or something, they're going to deny your claims because they won't know who you are. Your out-of-state providers need to be billing back to Blue Cross Blue Shield of Illinois. And that is all the questions that I see coming through. So I will say thank you again for spending time with us today. And I hope that I've answered some of your questions. Remember the recordings. Remember to call the fund office and talk to the fund office retirement benefits team with any additional questions you have. Thank you so much. Enjoy the rest of your weekend.